Please like, share, and subscribe. Wishing you happiness and good luck every day.
For decades, the term market wizard has been like a title for trading royalty. It's for that tiny group of people who've actually mastered one of the most competitive games on the planet. So what is it? What's the secret that separates these absolute legends from everyone else? Well, today, we're going to distill decades of wisdom from Jack Schwager's legendary interview series down to the core lessons that define these elite traders. And our map for this journey is Schwager's own condensed masterpiece, The Little Book of Market Wizards. You know, after spending years interviewing dozens and dozens of the top performers, he basically boiled all their advice down into one place. So let's dive in and unpack the principles he uncovered. All right, so where does the story of a market wizard even start? You probably picture some young genius making a brilliant call right out of the gate, right? But the reality, the truth for so many of these greats is that the first chapter of their story isn't success. It's spectacular, soul-crushing failure. And wow, this quote from Michael Marcus just hits you right where you live. It gets to the very heart of that experience. That feeling of staring at the ceiling after a huge loss, just questioning everything. Asking yourself, am I an idiot? I think almost anyone who's ever placed a trade can relate to that. But the amazing part isn't the question he asked. It's the answer he heard. Not you're done, but keep going. And trust me, Marcus knew what failure felt like. His early career was an absolute train wreck. I mean, look at this. He lost his first chunk of money listening to some so-called advisor. Then he lost another $500 on his own. Then, a pure luck trade in corn turns $3,000 into $30,000. He probably felt invincible, right? So what's he do? He borrows $20,000 from his mom, throws it in with his winnings, and proceeds to lose every single cent of it, plus another $12,000 of his mother's money. It was a total, unmitigated disaster. So here's the key takeaway. What was the difference between Michael Marcus, who later turned $30,000 into $80 million, and all the people who blow up and just quit? It wasn't that he was a better trader from day one. He failed bigger than most people can even comprehend. The difference was his insane persistence. Another wizard, Tony Saliba, said he literally felt suicidal after his first few trades. But just like Marcus, he refused to let failure win. And that's maybe the most important lesson of all. For the wizards, failure isn't a dead end. It's the tuition you have to pay to get in the game. Okay, so you've survived that initial trial by fire. What's next? The next part of the journey is finding your own way to trade. And this is where we just have to tear down one of the biggest myths in the entire industry. This idea that there's one secret formula, one holy grail out there that you just need to find. Just look at this. It's absolutely perfect. On one side, you've got Jim Rogers, a legend of long-term investing, a pure fundamental guy. He thinks the only way to win is through deep economic research. He famously said, "I haven't met a rich technician." And on the other side, Marty Schwartz, a trading champion. He tried using fundamentals for almost a decade and did nothing but lose money. His famous comeback? "I used fundamentals for 9 years and got rich as a technician." Think about that. These two guys got to the absolute top of their game while thinking the other guy's entire method was basically snake oil. And this slide makes the same point, but from a totally different angle: personality. Just try to picture it. Paul Tudor Jones's trading floor. Pure, high-energy chaos. People screaming, phones ringing off the hook, him literally jumping on desks. Now, picture Gil Blake. He would spend months in a library quietly scrolling through old microfilm, doing his research, and then he'd go home and trade from his bedroom. He methodically pulled in an average of 45% a year with almost no drama. Can you even imagine them switching places? No way. It would be complete disaster. Each of them built a system and an environment that was a perfect mirror of who they were. And this quote from Cole Moshe just nails it, doesn't it? He's talking about mentoring another trader, and he says, the point was never to make the guy a clone of him. The point was for the student to learn the core principles and then build a style that was 100% authentic to him. Success isn't about copying your heroes. It's about finding out how to become the best possible trading version of you. Okay, so if there's no single secret method, what's the common ground? If a guy who reads economic reports and a guy who draws lines on a chart can both be wizards, what do they actually share? What are those foundational pillars that every single successful trading style is built on? Let's get into it. I want to kick this off with a question you hear all the time. There's this old saying on Wall Street, right? Even a bad trading system can make money with good money management. So, is that true? Can you just manage your risk so well that it makes up for a flawed strategy? Well, according to the wizards, the answer is a huge, emphatic no. And the book has the perfect analogy. That's like asking if your special betting system can beat a roulette wheel. It can't. The casino has a small mathematical edge. The longer you play, the more certain it is that the house will win. Money management is absolutely vital, but it's defense. It can only protect you if you already have a strategy that has a positive edge, a system that over time is more likely to make money than lose it. Without that edge, all great money management does is help you go broke a little more slowly. And this gets us to what Schwager calls the great paradox of trading. So many people are drawn to the markets because, it looks like an easy way to get rich. The reality? It's the complete opposite. The book makes this hilarious point. Nobody reads Brain Surgery for Dummies on a Saturday and then shows up to the hospital Monday morning asking for a scalpel. But people do the financial equivalent of that every single day. And why? Because on your very first trade, you have a 50-50 shot of being right by pure luck, which creates this incredibly powerful and dangerous illusion that you know what you're doing. The wizards, of course, are not fooled by this. They know it's not about luck. It's a competition. Just listen to Marty Schwartz. He says his whole attitude is that he wants to be better prepared than anyone he's up against. That edge doesn't just appear out of nowhere. It comes from hard, disciplined work, day in and day out. So, we've got it. You need an edge, and you need to work your tail off to find and maintain it. But now, we have to talk about the hardest part of this whole thing, the part where most traders actually lose the war, the mental game. This is the real battlefield. So let's solve that little paradox we talked about. All that hard work, all that grinding that Marty Schwartz was talking about, where does it go? The wizards pour every ounce of that effort into their preparation. The research, the chart time, the back testing, the planning for every scenario. That's where the struggle is supposed to happen. Because, and this is the amazing part, when it's time to actually execute a trade, the process should feel almost effortless. It shouldn't be a fight. You shouldn't be sweating, hesitating, or trying to force it. If it feels like a struggle in the moment, it means something was wrong with your preparation. One of the traders in the book put this so beautifully, using an analogy from Zen in the art of archery. He said, a master archer doesn't try to hit the target. After thousands of hours of practice, they just learn to let the arrow shoot itself. The perfect shot is a release, not an effort. And it's exactly the same for a perfect trade. It just flows from all that deep preparation without any internal battle. But, okay, what about when things go completely sideways? What happens when you hit one of those horrible, confidence-shattering losing streaks? Well, the wizards all have the same emergency plan. First, you do what Paul Tudor Jones does. You immediately slash your position size. You should be trading your smallest when you're trading your worst. It's that simple. Second, if it keeps getting worse, you just stop. Michael Marcus said he had to learn to just tell himself, nope, you can't trade right now. And third, take a break. Get away from the screen, clear your head, and come back when you're fresh. So all of this, surviving failure, finding your own style, doing the hard prep work, mastering your mind, it all leads to one final, ultimate rule. This is the prime directive that sits above everything else a market wizard does. Survive. Paul Tudor Jones said it best. And this right here is the big mindset shift that separates the amateurs from the pros. Amateurs are obsessed with how much money they can make on a trade. Pros are obsessed with protecting the money they already have. Your number one job is not to hit a home run. It's to make sure you're still in the game tomorrow. So how do you actually do that? Call Moshe gives us the professional's blueprint, and it is the exact opposite of what most people do. Step 1. Before you even think about anything else, you find the price on the chart that proves your idea was wrong. That's your stop loss. It's based on logic, not on how much money you can stomach losing. Step 2. You decide the absolute maximum dollar amount you're willing to lose on this trade. And only then, step 3, you calculate your position size based on those first two numbers. Amateurs do it backwards. They pick a big position size first and then set a stop based on whatever feels okay emotionally, a feeling the market couldn't care less about. And that brings us to this, the final, perfect piece of wisdom from the legendary Bruce Kovner. This is the core of it all. You have to know your exit point before you ever enter. And why is that so important? Because the moment right before you click the button is the last moment you have any real objectivity. As soon as your money is on the line, your brain chemistry changes. Fear and greed take over. This rule is your shield against your own emotions. So let's wrap it up. Failure is your entry fee. Your method has to be your method. The hard work happens in preparation so that execution can feel easy. And most of all, survival is everything. The lessons from the market wizards aren't complicated, but they are incredibly powerful. You now know the most important rules of the game. The only question is, will you have the discipline to actually follow them? You know that feeling when you start something new and it's just so bad you think it's over before it's even begun? We hear it all the time, right? First impressions are everything. But what if that's just not true? Today, we're going to dig into some absolutely incredible stories that pretty much blow up the idea that our first failures decide our future. So let's get right into it. Now, really, I want you to think about this for a sec. Picture it, your biggest shot, your moment in the spotlight, and you completely, totally bomb. It's a complete disaster. Could you recover from that? Could you get back up? That's really the heart of what we're talking about today. All right, so for our first story, we're heading to the baseball diamond. We're going to talk about the absolutely disastrous debut of a pitcher named Bob Gibson. And trust me, his story is the perfect place to start. So, let's set the scene. It's April 15th, 1959. The St. Louis Cardinals are down against the Dodgers. And this young rookie, Bob Gibson, gets the call from the bullpen. This is it, his major league debut. I mean, this is the moment every kid who's ever picked up a baseball dreams about, right? The pressure has got to be just off the charts. So what happens? Well, the very first batter Gibson ever faces in the big leagues smacks a home run, just like that. Bam, a totally crushing blow. And hey, to put this into perspective for you, only 65 pitchers in the entire history of baseball have had that happen to them. I mean, you literally can't script a worse start. Oh, but it doesn't stop there. It actually gets worse. The very next inning, Gibson gives up another home run. His dream debut is just turning into an absolute public nightmare, right in front of everyone. This wasn't just a little stumble. No, this was a full-on, spectacular faceplant on the biggest stage imaginable. And the failure just kept coming. It was like a cascade. They bring him in the next night, he gets hit hard again. A couple nights after that, he gives up a crucial double. So what happens? Well, first he's benched for a week. And then the ultimate humiliation for a rookie. He gets sent right back down to the minor leagues. I mean, from where everyone was standing, his career looked completely dead on arrival. But here's the thing. That is not the end of the story. Let's fast forward to 1968. That same Bob Gibson posted an earned run average of 1.12, a number so incredibly low, it was the best the league had seen in over 50 years. Seriously, how is that even possible for the guy whose career just imploded on the launch pad? It's possible because that disastrous start was not predictive at all. Gibson went on to have one of the most dominant careers in the history of baseball. We're talking 17 seasons, more than 3,000 strikeouts, 2 Cy Young Awards, 2 World Series MVP awards, a first ballot, no doubt about it, Hall of Famer. It is just a perfect, brilliant example of our main idea today. A terrible beginning does not have to be the end. Okay, so let's switch gears a bit. Let's see how this exact same idea plays out in a totally different world, the super high-stakes world of commodities trading. I want you to meet Michael Marcus. He's a guy who didn't just fail once, he failed twice. And he did it in absolutely spectacular fashion. So Marcus's journey into trading, it starts back in college. He hires this so-called advisor who turns out was, well, completely clueless. He lost money on every single trade. Then he gets this can't-lose idea about pork bellies. So they put the trade on, they go to lunch, feeling pretty good, they come back, and his account is just gone, almost completely wiped out. Total disaster. So what do you think he does? He doubles down. I mean, he actually managed to turn $3,000 into $30,000, but then he borrows $20 grand from his own mother and puts the whole $50,000 on the line to trade corn futures. I mean, you can just feel it, right? The stakes are now unbelievably high. So his whole bet was based on this theory that a corn blight was going to come back. And for a while, the market was kind of quiet, it was holding steady, but then this headline hits. Just a devastating headline that completely, totally shattered his theory. And the market? Oh, it reacted instantly and violently. The corn market didn't just fall, it went locked limit down. Now, this is a really important term to understand. It means the price dropped by the absolute maximum amount it's allowed to in a single day, and at that point, trading just stops. It freezes. You've got sellers trying to get out everywhere, but there's literally nobody buying. So Marcus was just paralyzed, forced to sit there and just watch as all his money and his mother's money just vanished into thin air. He lost everything. Again. So, I mean, how do you possibly come back from that? You've lost your life savings, you've lost your mother's money. This is that moment, that critical turning point, and we're going to see it not just with Marcus, but with another trader who also hit rock bottom. It's really all about that mental shift, what happens in your head after the disaster. Marcus actually talked about having these conversations with himself. He'd be looking up at the sky, just asking, am I really that stupid? And he said he would hear this voice answer him, clear as day, no, you are not stupid, you just have to keep at it. That little internal voice, that refusal to just give up, that was everything. So, did he keep at it? Oh, you better believe he did. He got a job at a trading firm. They gave him a starting account of $30,000. And over the next 10 years, he turned that 30 grand into $80 million. Let that sink in. From 2 complete catastrophic wipeouts to becoming one of the most successful traders of all time. It's just an absolutely mind-blowing turnaround. And what's crazy is Marcus's story of hitting rock bottom, it's not one of a kind. Take another trader, Tony Saliba. He had this blazing hot start. I mean, he ran a $50,000 account up to 75 grand in just 2 weeks. He probably thought he was invincible, a real genius. But then the market turned, and that super high-risk strategy of his, it backfired big time. In 6 weeks, his account crashed all the way down to just $15,000. Saliba's despair, it was just profound. He actually remembered a major plane crash that happened around that time at O'Hare Airport, and he said he felt so low he would have traded places with anyone on that flight. Think about that. He felt like a total failure, like his life was completely ruined. This is what absolute rock bottom sounds like. But just like Marcus, he didn't quit. He went out, he got some advice, and he totally transformed his approach. He went from this get-rich-quick mentality you see on the left to a goal of just being consistently profitable. He swapped out the wild, high-risk gambles for discipline, for homework, for cautious risk control. The bottom line is he actually learned from that catastrophic failure. Okay, so we've heard these incredible stories, right? Disastrous starts, legendary comebacks. So what's the takeaway? What are we supposed to learn from all this? Let's try and boil it all down to the key lessons. Here's the most important point, I think. Failure isn't just something to get over, it's actually a teacher, and a powerful one at that. All that experience they gain from those huge catastrophic losses, the source material calls it their market education, that was the exact thing that built their future success. Yeah, that knowledge was incredibly expensive, but in the end, it was absolutely priceless. And all of this really brings us to 2 core principles. Number 1, failure is not predictive. A bad start doesn't just happen, it's pretty much the norm, even for the people who end up becoming masters of their craft. And number 2, persistence is absolutely instrumental. It's everything. Without it, none of these guys would have ever discovered what they were truly capable of. So, okay, those are some great principles, for sure. But how do we actually use them? Let's get practical here for a second and look at a real takeaway, especially if you're in any kind of high-risk field. Well, if you accept the fact that most beginners are going to fail at first, it points to something really logical, doesn't it? If you know you're gonna have to learn some hard lessons, you might as well make them as cheap as possible. Start small, use small amounts of cash, and think of those first losses because they're probably inevitable, not as failures, but as tuition. You're literally paying for your education in the market, and believe me, it's way better to pay a small price for those early lessons than a big one. So let's wrap up with this thought. Failure, it has a really loud voice, doesn't it? And it's almost always screaming the same thing at you. Quit. Just give up. This is too hard. You're not good enough. But persistence asks a totally different question, a much more powerful one. It doesn't pretend the failure didn't happen. It looks right at it, and then it asks you, okay, so what's your next move? Welcome. Today, we're going to dive into a question that honestly sends so many traders on a total wild goose chase, this hunt for some kind of secret formula for success. We're going to talk about what is not important and why letting go of that search is probably the first real step you can take. So this is the big one, right? This is the question that fuels 1 million books, 1,000 courses, and way too many late-night research sessions. Is there some hidden key, some perfect system that if you could just find it would unlock everything? A lot of us are led to believe that success is all about finding this one holy grail. The idea is if you could just get your hands on that one perfect approach, you'd be set for life. But as we're about to see, that entire search might just be a huge distraction from what really truly matters. To really get what I'm talking about, let's look at our first titan of the trading world, Jim Rogers. This is a guy who built an absolutely legendary career on a very specific and very strong philosophy.
I mean, just look at this guy's resume. He co-founded the Quantum Fund with George Soros, only one of the most successful hedge funds in history. After that incredible run, he just left to manage his own money, dedicating himself to this deep, deep research and spotting these massive, long-term trends before anyone else. This is a voice you definitely want to listen to.
And his calls were just staggering. At a time when the Japanese stock market was on this explosive tear, Rogers was convinced a massive collapse was coming. He predicted it would go down 80, maybe even 90%. People thought he was absolutely insane. And yet, he was completely right. The Nikkei index lost about 80% of its value in the years that followed. Just incredible. So, how'd he do it? What was his big secret? Well, it was actually pretty simple. Rogers is a pure, hardcore fundamental analyst. He bases his decisions on the big picture stuff, economic trends, political shifts, supply and demand, basically the real-world health of an economy or commodity. He could not care less about the little squiggles on a price chart. In fact, when somebody asked him about technical analysis, the art of reading charts, his response was just legendary in how dismissive it was. He said, "I haven't met a rich technician." So for Rogers, the secret was fundamentals, and pretty much everything else was just noise. He didn't just ignore technical analysis, he thought it was a complete joke. Okay, so case closed, right? Fundamentals are the key. It's gotta be. Well, hold on. Let's meet our second titan, a trader named Marty Schwartz, and he represents the complete polar opposite end of the spectrum. Now, Schwartz's results are just as mind-blowing as Rogers is, but he got there in a totally different way. He took a $40,000 account and turned it into over $20 million. And here's the key part. He did it with insane consistency, never having a losing month of more than 3%. When he entered public trading contests, his results were off the charts, averaging a 210% return in these 4-month competitions. And get this, in a 1-year contest, he scored a jaw-dropping 781% return. Now, this is not long-term, patient investing. This is explosive, high-octane trading. So clearly, just like Rogers, Schwartz is another guy whose opinion you have to take very, very seriously. But here is the absolute kicker to Marty Schwartz's story. For nearly a decade, 9 long years, he tried to be a fundamental analyst. He tried to do it the exact same way that made Jim Rogers a legend. And what happened? He lost money, consistently. For 9 years, the so-called right answer was completely and totally wrong for him. So, here's the point. Marty Schwartz only became a superstar trader after he threw fundamentals into trash and became a pure technician. He got rich using the very method that Jim Rogers claimed couldn't make anybody rich.
And this, right here, brings us to a fascinating head-on collision of philosophies. You've got 2 giants of the industry, both with undeniable, incredible track records, who completely, 100% disagree on how to win.
So in one corner, you've got Jim Rogers, the fundamentalist legend, basically saying that looking at charts is completely useless. And in the other corner, you have Marty Schwartz's actual life story, which is the perfect comeback. He literally tried it Rogers' way for almost a decade and failed, then got rich using the very method Rogers laughs at. So let's just break this down, because it's pretty wild when you see it side by side. Rogers uses fundamentals, thinks technicals are junk, and is a massive success. Schwartz lost his shirt with fundamentals, uses technicals, and is also a massive success. Both of these guys basically think the other one's method is worthless. So how? How can 2 completely opposite approaches both lead to such incredible results? Okay, this is where we finally get to the real secret. And I'll tell you right now, it's not what most people spend their time looking for. Let's try to make sense of these 2 totally different viewpoints. So who's right here? Who wins the argument? Is it the fundamentalist, Jim Rogers, or is it the technician, Marty Schwartz? Their stories just force you to ask that question. And the answer, believe it or not, is unbelievably simple. They both are. Rogers is right for Rogers, and Schwartz is right for Schwartz. The huge mistake we all make is assuming there has to be one single correct way to trade. So here's the real takeaway. Market success is not about finding the one true methodology. It's about finding the methodology that is right for you. It's a journey to find what fits your personality, your risk tolerance, your time frame, all of it. It's about personal fit, not some universal truth. And what that means is that there are tons of valid paths to success. You can absolutely win with pure fundamentals like Rogers or with pure technicals like Schwartz. You can use a mix of both. You can hold positions for years and years, or you can trade on a scale of just a few minutes. Any of these can work, as long as it truly aligns with who you are. There's this great line that sums it up perfectly. There are a million ways to make money in the markets. Unfortunately, they're all very difficult to find. And that's the reality, isn't it? There's no single easy answer, but there are lots of answers out there. The real work is in finding your own.
And so, that's where we'll end. The real secret isn't a formula. It's a better question to ask yourself. The goal shouldn't be to ask, what is the secret to the markets? The goal is to ask, what is the right methodology for me? The answer to that second question, that's where your journey to real, lasting success actually begins.
You know, almost every aspiring trader is on the hunt for one thing. That secret formula, that one magic key to unlocking the markets. But what if I told you the most powerful strategy isn't a formula at all? What if it's all about finding a way to trade that is uniquely and completely you?
So, here's our game plan for today. We're going to start by uncovering the one big secret that all great traders have in common. Then we'll dive into the worlds of two absolute legends who couldn't be more different. From there, we'll talk about why knowing yourself is your biggest asset. We'll expose that common black box system trap, and finally, we'll zero in on where your real trading edge is hiding.
All right, let's get right into it. What is that one thread, that one principle that connects every single successful trader, no matter what their strategy looks like?
I mean, this is the question that keeps people up at night, right? Is there some kind of holy grail out there? A single, perfect system that just prints money? People spend fortunes looking for it. But does it even exist?
Well, the surprising answer is a flat-out no. There is no one single correct way to trade. And you know what? That's fantastic news, because while there isn't one path, there is one guiding principle that changes the entire game.
And here it is. This is the whole shebang. Success isn't about finding the quote-unquote best methodology out there. It's about finding the one that is the best fit for your personality. This is the rule that all the greats live by. They didn't just copy someone else's system, they built one that was true to who they are.
And to really see this idea in action, let's look at two titans of trading who are polar opposites. Seriously, this perfectly shows how two completely different approaches can both lead to massive success. First up, meet Paul Tudor Jones. I want you to picture a trading floor, just buzzing with electric energy. Jones is right in the middle of it all, like a conductor in a symphony of pure chaos. His eyes are darting between monitors, he's shouting orders, phones are ringing off the hook. It's intense. And his results were just as intense. Get this, during the historic market crash of October 1987, a month that wiped people out, Jones posted a mind-blowing 62% gain. And this wasn't a one-off. He actually pulled in triple-digit returns for 5 years in a row.
This is what it actually sounded like in his office. A constant storm of action, gut feelings, and pure aggression. He didn't just survive in that environment, he thrived in it. Okay, now hold that image.
Now, let's step into a totally different universe. Meet Gil Blake. Forget the chaos. Blake's office was the quiet of a local library. He actually started out as a total skeptic, spending months hunched over microfilm, just trying to prove to a friend that the markets were completely random. Blake's whole approach was quiet, methodical, and based on deep research. And his results? A different kind of unbelievable. He averaged 45% a year for 12 years, and at one point had a streak of 65 straight winning months. That kind of consistency is just staggering.
So look at the contrast here. It's everything. You've got Jones in his crazy office trading constantly on raw intuition, and then you have Blake in his quiet bedroom, maybe making one trade a day based on years of systematic research. They are night and day. Yet both were massively successful.
I mean, just try to picture it for a second. Can you imagine the hyperactive Paul Tudor Jones sitting quietly in a library for months? Or the calm, methodical Gil Blake thriving in an office where everyone's shouting? No way. The image is just wrong, because it doesn't fit who they are. They each found what worked for them.
So this isn't just a cool story about two traders. It's a universal truth about finding your own fit. And to really understand the cost of getting it wrong and the incredible payoff for getting it right, let's look at one more trader's story.
For almost 10 years, a guy named Marty Schwartz tried to be a fundamental analyst. It was a horrible fit for his personality. And even though he was making a good salary, he just kept losing money in the market. He was nearly broke. Then he found technical analysis, which let him get in and out of trades fast. It clicked with his personality perfectly, and boom, he became a huge success. The strategy wasn't magical. He just found the one that was right for him.
This quote from another manager, Cole Moshe, just nails it. He had a friend work with him for years, and that friend didn't become a clone of O'Shea. Instead, he learned how to become the best version of himself. See, the goal isn't to copy someone else, it's to discover yourself. Now, this whole principle of finding a personality fit, it also explains a really common and painful trap that so many people fall into: the failure of those so-called black box trading systems. We've all seen the ads, right? These black box systems that promise easy, guaranteed profits. Well, here's a wild statistic. Over 90% of the people who buy them end up losing money. So how can the failure rate be so high, especially if this system itself might actually work? Well, it comes down to this really predictable psychological loop. You buy a proven system, but you don't really understand its guts. So when it inevitably hits a losing streak, and believe me, every single system does, your confidence just crumbles. It wasn't your research, it wasn't your conviction. So you lose faith, you dump it, usually right before it starts winning again. The problem wasn't the system, it was the fact that it wasn't your system. And this all brings us to the most important takeaway from all of this. After seeing what works and what doesn't, we can finally see where a trader's real, lasting edge actually comes from. Let's just boil it down to its simplest form. The hunt for the best system in the world is a total distraction. The real work, the real secret to success, is the journey to find the best system for you. So often, we think we need to fight against our own instincts to fit into some external model of what success should look like. But this whole idea flips that on its head. It suggests that your natural personality, your beliefs, your unique talents, they aren't roadblocks. They're actually the compass that will point you to your path. And so that's the final question I'll leave you with. Forget what worked for Paul Tudor Jones or Gil Blake for a minute. The real question is for you. In your trading, in your career, in any part of your life, what is the approach that is authentically, powerfully, and successfully you?
All right, let's get right into it. You've probably heard this piece of Wall Street wisdom a million times, right? It sounds so smart, so responsible. But what if I told you it's not just a little bit wrong, but actually dangerously wrong? Today, we're going to tear down a really popular trading myth to figure out what really separates the winners from the losers in the markets.
So here's the game plan for this explainer. We're going to kick things off by exposing that dangerous myth. Then, believe it or not, we're taking a trip to the casino to understand a little something about mathematical certainty. From there, we'll nail down what a real trading edge even is, lay out the two-part formula for success, and wrap it all up with a really important readiness check for anyone in the markets. Okay, first things first, let's really dig into this piece of market folklore. It's one of those sayings that's been passed around for so long that, people just accept it as truth without ever stopping to ask, does this actually make any sense? And there it is. Even a poor trading system could make money with good money management. I mean, it sounds right, doesn't it? It's all about being cautious, being disciplined. But is it actually true? Can you really just manage your risk your way into profits if your entire strategy is a losing one to begin with? Well, the short answer is a big, fat no. In fact, the source for this whole explainer calls this idea one of the stupidest things that has ever been said about trading. I know that sounds harsh, right? But stick with me, because there's a really powerful and simple way to prove why that statement is spot on. So to really see why this myth just completely falls apart, we've got to step away from the trading desk for a minute. We're heading to a casino. Why? Because a simple roulette wheel is the perfect and most brutal test for this very idea. So, picture it. You walk up to a roulette table, and you've got a crisp $1,000 bill in your hand. The goal is simple. Walk away with more than you started with. You can bet it however you want, 100 small bets, 10 medium bets, you name it. Now here's a fun thought experiment. If you took 100 mathematicians and asked them for the absolute best, mathematically optimal betting strategy, what do you think they'd tell you? Would they say, oh, make small, careful bets to protect your capital, spread the risk around? The real answer is probably not what you're thinking. Every last one of them should give you the exact same, completely counterintuitive answer.
Bet the whole $1,000 on a single spin. Red or black, that's it. Win or lose, you get up and you walk away. And what's so odd about this is that betting it all at once is the perfect example of what we'd all call terrible money management.
So, why on earth is that the best strategy? Well, on a typical American roulette wheel with that double zero, your odds of winning on that one big bet are 47.37%. See, it's still under 50-50. You still have a negative edge. The house always has the advantage.
And this just nails the core problem, doesn't it? If you make one big bet, you give the house's negative edge just one shot to work against you. But if you make $110 bets, you're giving the house's edge 100 chances to grind you down. The longer you play a losing game, the closer you get to a mathematical certainty. You're going to lose. So here's the bottom line, the absolute key takeaway. Good money management is totally useless. Actually, it's worse than useless if you don't have an edge. You simply cannot manage your way out of a game that you are statistically guaranteed to lose over the long run.
Okay, so if good money management isn't the magic wand we thought it was, then what is? Well, the answer is the only thing that really matters, having an edge.
So let's be super clear about what an edge actually is. It is not a gut feeling. It's not a hot tip you got from your buddy. An edge is a specific describable methodology that gives you a positive expectancy. And in plain English, that just means that over a whole bunch of trades, your strategy is statistically proven to make more money than it loses.
To make this crystal clear, an edge is a system. It's something you can literally write down step by step that someone else could follow. It is not just staring at a chart and going, looks like bonds are going to go up, I'll buy some. It's the absolute opposite of that cavalier shoot-from-the-hip approach. It's disciplined, it's methodical. But, and this is a really important but, here's the next layer. Just like money management is useless without an edge, well, having an edge all by itself isn't quite enough either. Real long-term success comes from combining the two.
The legendary trader Monroe Trout, who had just an incredible track record, he put it perfectly. He said you need both. And pay attention to his wording there. Money management doesn't create the profits for you. But for a winning system, it can make the difference between success and failure.
So, here's the winning formula. It's a 1-2 punch. Step 1, you must have an edge, a specific system with a real statistical advantage. Then, step 2, you apply risk control, or good money management, to protect your capital while that edge gets to work over time. They're partners. One finds the opportunity, the other makes sure you stay in the game long enough to profit from it. And that brings us to the final and honestly the most important part of this whole thing. It's time to take these ideas and turn them into a personal checklist. There are two simple but incredibly powerful questions that every single trader needs to be able to answer.
First one, what exactly is your methodology? And I don't mean in some vague general sense. I mean, could you write it down on a piece of paper, step by step, so clearly that someone else could execute it without you? Is it specific? Is it repeatable?
And then, the second absolutely critical follow-up question. Does that method of yours actually provide an edge? Have you tested it? Do you have actual evidence, not just a feeling, not just hope, that it has a positive expectancy over a large set of trades?
Now, here's the blunt truth from our source material today. If you cannot look yourself in the mirror and confidently, without a shred of doubt, answer yes to both of those questions, you are simply not ready to be risking real money in the markets. Full stop.
And that really leaves us with one final big question to think about. If you can't clearly define your edge, are you really trading? Or are you just pulling up a chair to the roulette wheel in the world's biggest casino, crossing your fingers and just hoping for the best, while that negative edge slowly but surely grinds your account to zero?
All right, let's talk about something we've all probably heard. This really tempting idea that trading is some kind of shortcut to getting rich. You know, that with just a little bit of knowledge and a couple of clicks, you can make a ton of money. But is that really how it works? Today, we're going to dig into what it actually takes to make it.
So you've probably seen this kind of thing before, right? This is the dream they sell you, this idea that you can just pick up a book, watch a few videos, and bam, you've cracked the code to the markets. It's this allure of fast, almost effortless cash that pulls so many people into trading every single day.
Okay, but let's be real for a second. If it was that simple, wouldn't we all be millionaires by now? And that's the real question we're getting into here. The myth of easy money versus the reality, which, you'll see, is a whole lot grittier.
To really get to the bottom of this, we need to pull back the curtain and look at some of the most successful traders ever, the people they call the market wizards. And trust me, their daily lives look nothing like the ads. So take a guy like Marty Schwartz, an absolute legend in the trading world. The guy who interviewed him for the Market Wizards book caught up with him late at night after a full day of trading. He was exhausted, but was he done? Nope. He still had hours of his analysis routine to get through. That quote right there, that wasn't just some nice-sounding platitude. It was his whole philosophy. For him, the preparation wasn't just part of the job, it was the job.
And here's the thing. Schwartz wasn't some kind of outlier. When you really look at the greats, this is a pattern you see over and over again. They're basically workaholics. So you can forget that picture of someone trading from a beach hammock. The reality for the people at the top is this intense, obsessive, all-consuming drive. I mean, just look at the resume of David Shaw. Just running one of the most successful quant trading firms in the world, a company that hires genius-level physicists and uses super complex computer models. That sounds like more than a full-time job, right? But for Shaw, that was just the start. He was also launching other huge companies, diving into a totally separate and incredibly complex scientific field, and advising the President of the United States on science and technology. It's just mind-boggling.
When someone asked him if he ever took a vacation, this was his response. Think about that for a second. For him, work wasn't something to escape from. It was something he needed to do every single day just to feel okay, just to feel sane. That's a level of dedication that most of us can't even really wrap our heads around.
And if you thought Baited Shaw was extreme, let me tell you about John Bender. This guy was a superstar options trader for George Soros' legendary quantum fund. And his performance was just staggering. We're talking an average annual return of 33%. And in his last year, he posted a gain of 269%. How on earth did he do it? Well, he basically never stopped. He would trade one market, and as it closed, he'd move on to the next, just following the sun around the planet.
20. Let that sink in. It was completely normal for John Bender to trade for up to 20 hours a day. He'd start with the Japanese markets, stay up for Europe to open, and then trade straight through the US session. Now, nobody is saying this is healthy, but it's a crystal clear look at the insane level of work behind elite success. It completely shatters that easy money myth. Okay, so we've established that the best traders are some of the hardest working people out there. Which brings us to a really interesting paradox. If it takes that much grinding, why does pretty much everyone think trading is the one job where you can get rich without even trying? This really puts it in perspective. Imagine someone told you they read a book on brain surgery over the weekend and they were going to go operate on someone on Monday morning. You'd think they were insane, right? It's an absurd idea. And yet, people do the exact same thing with trading all the time. They'll read a book about making millions in the market, and come Monday, they feel totally ready to jump in and compete with the pros. The logic is identical, but how we see it is totally different.
So why? Why do we look at those two situations so differently? What is it about trading that makes us think the rules of every other skilled profession just don't apply? Well, the answer is kind of baked into the very nature of the market itself.
The whole reason for this paradox, this weird blind spot we have, is actually pretty simple. It all comes down to the sneaky role that pure, dumb luck plays in trading, and how easily we mistake that luck for actual skill. Think about it this way. In any other highly skilled field, being a surgeon, a pilot, a professional athlete, a total beginner's chance of succeeding is basically zero. You can't just walk in and do it. But in trading, on your very first decision, what are your choices? Buy or sell. That's it. You have a 50-50 shot of being right from the very start without knowing a single thing.
Yep, that first click you make, it's basically just a coin flip. The price is either going to go up or it's going to go down. And this incredibly simple 50-50 choice is the bait in a huge psychological trap. To see how this trap works, imagine you get 1,000 people together and have them each flip a coin 10 times. Just by pure random chance, about 300 of them, that's almost a third of the group, are going to get heads more than 60% of the time. But here's the key. Not one of them is going to walk away thinking they have a special gift for flipping coins. They know it was just luck. But, and this is the huge difference, when that same luck happens to a beginner in the market, when they get a few trades right in a row, they don't chalk it up to chance like the coin flippers. No way. They think it's because they're brilliant. That early, random success creates this powerful illusion of skill, and it fools them into thinking, hey, this is easy. So let's put all the pieces together here. On one hand, you've got this illusion that luck creates, and on the other, you've got the cold, hard reality of what the pros are doing. And telling the difference between those two things, well, that's everything.
This really brings us full circle and cuts through all the hype. A beginner might get lucky for a bit, but long-term, real, sustainable success, it never comes from luck. It comes from the relentless, obsessive grind put in by people like Marty Schwartz, David Shaw, and John Bender. It comes from hard work, period.
And that leaves us with one last idea to chew on, and this goes way beyond just the stock market. We've seen how easily luck can look like skill when money is on the line. So, think about any part of your own life. How can you tell the difference? What separates a one-time lucky break from true, repeatable, hard-earned skill? Now that is a question worth thinking about.
All right, let's get right into today's topic, which has a title that might make you do a double take. Good trading should be effortless. I know. You're probably thinking, wait a minute, isn't trading supposed to be incredibly hard work? It feels like a total contradiction, doesn't it? But what if I told you there's a really profound truth hidden right inside that paradox? Exactly. Which one is it? In our last explainer, we hammered home how much hard work trading takes, and now all of a sudden, we're saying it should feel effortless. It seems like we're flipping the script completely, but we're not. And honestly, understanding why it's not a contradiction, well, that's one of the biggest keys to unlocking peak performance. So here's how we're going to break it all down today. First, we'll tackle the trading paradox itself. Then we'll get into the most important part, the difference between preparation and process. We'll look at what happens when you're out of sync. I'll tell you a wild story about a forbidden interview, and we'll wrap it all up with the core lesson, learning to let the arrow shoot itself. Okay, first up, the trading paradox. Let's really get into how two ideas that seem like total opposites can actually both be true at the same time. Here's the secret. There isn't actually a contradiction here at all. The key isn't about choosing one or the other, hard work or effortlessness. It's about understanding that they belong in two completely different stages of the game. And once you see that, man, it changes everything. The solution, the whole thing, really just boils down to separating preparation from process. Think of it this way. All the grinding, all the research, all the analysis, that's one phase. But the execution, the actual act of placing the trade, that should feel like something else entirely. And that brings us right to the heart of this whole concept. Preparation versus process. This is where the light bulb really goes on. So look at this. We've got two completely different worlds, side by side. On the left, you have preparation. This is the hard work. This is the grueling, late-night research, the backtesting, the training, all the blood, sweat, and tears. But on the right, you have the process. This is the execution, the performance. And that stage, that's where it should feel effortless. It should feel like you're in a state of flow. To really make this stick, let's use an analogy that I think everyone can get their head around pretty easily. Let's talk about a world-class runner. Okay, picture someone who's completely out of shape trying to run a mile. They are straining, gasping for air. It's just pure maximum effort for a pretty terrible result, right? Now picture an elite marathoner. They're just gliding along, running a sub-5-minute mile, and they almost make it look easy. Now, in that moment, who is working harder? It's the out-of-shape runner, no question. The elite athlete's performance looks effortless only because it's built on a foundation of years and years of brutal preparation. All the hard work was already done long before race day. And this isn't just about running, you guys. This is a universal principle. The best writers talk about getting into a state where the words just flow onto the page. The greatest musicians become one with their instrument on stage. And yeah, the best traders execute a plan they've researched to death, almost, seamlessly. In every single case, the performance itself feels easy. So what happens when it doesn't feel easy? This brings us to a really critical point. What do you do when you feel totally out of sync with the markets? This is a trap that so many people fall into. When you're on a losing streak, your first instinct is to clench your fists, grit your teeth, and just try harder. But forcing it during the process, during the live trading, is the absolute worst thing you can possibly do. It just digs the hole deeper and deeper. And here is the big distinction you have to make. You can't work harder at the act of trading itself. That's trying to force the process. But you absolutely can, and you should, go back to the preparation phase. Go work harder on your research. Go work harder on analyzing what went wrong.
You have to shift that effort away from execution and put it back where it belongs, in the preparation. Now, where does this powerful insight even come from? Well, it's actually from a really fascinating behind-the-scenes story, a story about an interview that was almost never, ever published. So Jack Schwager, the author of the Market Wizards books, he has this policy. To get these legendary traders to really open up, he promises them final approval over their chapter. It's great because it helps them speak freely, but sometimes it can really backfire. And in one particular case, it almost did, in a big way. So the author conducts this really out-there interview, covering all these eclectic topics like dreams and Zen and how they relate to trading. He writes up the chapter, he's thrilled with it, he thinks it's one of his best. But when he sends it over to the trader for review, the trader's brand new business manager gets a hold of it and immediately shuts it down. The final word comes back, nope, you can't use it. And why? Well, it turns out the trader was about to launch a new corporate advisory service. And all this talk about Zen and trading and dreams, it didn't exactly fit the buttoned-up super corporate image they were trying to project. The business manager basically saw it as a huge liability, and the chapter got vetoed. It was dead. But the author just hated the idea of losing all that wisdom. He thought it was too valuable to just throw away. So he negotiated a compromise. He asked, what if I just publish a tiny 2-page section and we don't even use the trader's name? The trader agreed, and that small, salvaged piece of the interview became its own chapter, titled Zen and the Art of Trading. And that brings us to the core lesson that was saved from that interview, a really powerful metaphor that just perfectly captures this whole idea of effortless performance. In this very short, anonymous chapter, the trader poses a simple question to the author. He just asks, did you ever read a book called Zen and the Art of Archery? And then he drops the central idea. The essence of mastery, he says, is that you have to learn to let the arrow shoot itself. Now just think about that for a second. It's not you shooting the arrow. You're letting it shoot itself. He went on to explain that in trading, just like in archery, anytime you feel effort or force, or you feel yourself straining, something is wrong. You're fighting the market, you're fighting yourself. He said the perfect trade, the one that comes from a place of true mastery and deep preparation, requires no conscious effort at all in that moment of execution. So really, what this all comes down to is a truth that all great performers recognize. Mastery feels effortless during the performance. And it's not because it was easy to get there. It's because all the incredibly hard work was done long, long before. The effort is in the preparation, so that the process can be pure flow. And this really leaves us with a final thought to take away, because this idea goes so far beyond trading. So I'll ask you, where in your own life are you straining and struggling, trying to force an outcome, instead of doing the preparation that's needed to just let the arrow shoot itself?
All right, let's jump right in. Today, we are getting into what might be the single hardest part of trading. And, it's got nothing to do with the charts, the algos, or what the economy's doing. Nope. It's all about what's going on right between your ears. We're going to go deep into the psychology of the markets by tapping into the wisdom of some absolute legends, the market wizards. We're going to see how they survive the absolute worst of times, and, this is the really important part, how they deal with the incredible highs when things are going great.
So let's kick things off with the big question for this whole explainer. And I gotta warn you, it's a bit of a curveball. We all know that feeling, right? The fear of a losing streak. It's just this gut-wrenching thing that can drain your account and your confidence. But what if the moment you feel like a genius, like you're completely invincible, right after a huge win? What if that's exactly when you're in the most danger? Yeah, that's the weird and honestly kind of scary reality we're going to unpack.
So first, let's talk about that monster that every trader knows, the drawdown. And this isn't just one bad trade, right? It's that grinding, soul-crushing period where every single decision you make feels wrong, your confidence is just gone, and your equity curve looks like it fell off a cliff. It happens to everyone, and how you handle it is what separates a long career from a quick, fiery burnout. Now, what's so fascinating is that nobody gets a pass on this. Every single legend we're about to talk about has gone through their own version of trading hell. The big difference is they don't just sit there and hope it gets better. They have a playbook, a clear process for when the market punches them in the face. And when you really look at what they do, all their advice really boils down to two fundamental survival strategies. And here it is, strategy number one.
This is the first, the most important, and maybe the hardest rule to actually follow when you're in a slump. It sounds so simple, but it is the absolute foundation of professional risk management. The second you realize you're trading poorly, you have to force yourself to trade smaller. Let's hear it straight from the masters themselves.
And this just perfectly captures the simple genius of it. Paul Tudor Jones, an absolute titan, isn't just suggesting this. He's saying it's a system. The whole point is to make your risk match your performance. By cutting your size down, you guarantee that when your judgment is at its absolute worst, when you're emotional and seeing things that aren't there, your financial risk is at its absolute smallest. It's just pure, simple logic.
Ed Seacoda, who's basically one of the godfathers of system trading, adds such a critical piece here. He talks about a gentle financial and emotional touchdown, and that's the key. A drawdown doesn't just hurt your wallet, it crushes your spirit, your psychological capital. So by cutting your risk, you're not just saving money, you are saving your own mind, making sure you can land softly, regroup, and get back in the game without carrying these deep scars from a huge loss.
Let's make this real for a second. This number, $600,000, is not a hypothetical. That was the actual loss that trader Marty Schwartz took in a single day. Just imagine that for a second. That's the kind of hit that would make most people just turn off their computer and never trade again. So what did he do next?
He didn't do what most of us would be tempted to do. He didn't try to revenge trade it all back with some massive heroic bet. No, he did the exact opposite. He immediately shrunk his size way down and just focused on stringing together a bunch of tiny little wins. He wasn't trying to hit home runs anymore. He was just trying to get on base. He was rebuilding his shattered confidence, one small win at a time. And here's the result. After being in a $600,000 hole early in the month, he ended that same month down only 57 grand. I mean, just let that sink in. By slamming on the brakes, he clawed back over $500,000. He turned what should have been a career-ending event into something he could recover from. That is what professional survival looks like. And listen, we're not talking about small little changes here. Just look at the scale of this. Randy Mackay, when he was feeling good, was trading thousands of contracts. But when he hit a slump, he'd cut his size by over 99%, down to just 10 contracts. That insane flexibility, the ability to go from full-on attack mode to pure defense in a split second, that's a superpower in this game.
Okay, let's get to strategy number 2. This is the emergency brake. This is for when things are so bad that just trading smaller isn't enough to stop the bleeding. When you are truly caught in that psychological death spiral, the only way to win is to stop playing. Sometimes the best move is the most drastic one. You just stop completely. And Michael Marcus nails the why behind this. He's talking about a toxic chain reaction. Losing kicks off pessimism, right? That pessimism clouds your judgment, which makes you make more bad trades, which of course leads to more losing. He knew there's a point where your mind, your biggest asset, has actually become your biggest enemy. And at that point, to keep trading is just self-destruction.
I honestly don't think anyone has ever said it better or more powerfully than Richard Dennis, the guy behind the famous turtle traders. Get your head out of the mixer. That image is just perfect because it captures the violent chaos of a really bad losing streak. It's not a puzzle you need to solve. It's a machine that is tearing you apart. And the only sane thing to do is to get out. It's an act of self-preservation.
So, what does this actually look like? Well, the playbook is pretty simple. Step 1. Sell everything. Get flat. No more, oh, maybe this one will turn around. Just get to cash. Step 2. Take a real break. I mean a real one. Get away from the screens. A vacation is perfect because it gets you physically and mentally out of the environment where all the bad stuff was happening. And step 3, and this is crucial. When you come back humble. You start small, you get your feel back, and you earn your confidence back.
All right, so we have a plan for when everything is going wrong. But now we're going to pivot. Because very often, the biggest threat to your trading career doesn't look like a threat at all. It looks like success. It's not hiding in the bottom of a drawdown, it's hiding at the very peak of a winning streak. What happens when everything you touch turns to gold? This quote right here, from Marty Schwartz again, is the key to this whole thing. Just think about how backward that sounds. The moments he should have been celebrating, when he was trading at his absolute best, were the direct setup for his biggest, most painful losses. And this wasn't just a fluke, it was a pattern he saw in his own trading over and over again.
So this brings us to the million-dollar question. How is that possible?
How can a period of pure success, where you feel like you finally cracked the code, be just as dangerous, or maybe even more dangerous, than a period of constant failure? The answer has zero to do with the market and everything to do with human psychology.
Let's just connect the dots here, because it's like a deadly domino effect. A great winning streak makes you feel overconfident, right? Maybe even invincible. And that feeling leads to complacency. Complacency leads to sloppy trading. You start breaking your rules, taking trades you know you shouldn't. At this exact moment, when you feel like a genius, you are least likely to even think about a worst-case scenario. And to top it all off, this is all happening when your position sizes are probably the biggest they've ever been. It is literally the perfect storm. So we've looked at two totally different states: the absolute agony of a deep drawdown and the pure ecstasy of a huge winning streak. They feel like they're from different planets, and you'd think they'd need totally different solutions. But what if the cure for both of them is exactly the same? What if there's one single idea that helps a pro handle both? And this right here, this is the big reveal. Look at this. The discipline you need to survive the worst of times, cutting your trading size, is the exact same discipline you need to protect yourself during the best of times. When you're winning big, when you feel like a god, the professional move is to pull back, to reduce your size, bank some profits, and protect yourself from your own ego.
So here's the bottom line. The real mark of an elite trader isn't how they react to a win or a loss. It's their ability to completely separate their process from their recent results. It's about the relentless, boring, day in and day out application of disciplined risk management, no matter if they feel like a hero or a total idiot. That consistency, that's the whole game.
Okay, so how can you actually apply this? Here's a super simple, super practical tool from Michael Marcus. Chart your own account equity every single day. Just doing that one simple thing turns your performance from an emotional story into cold, hard data. It's like a vital sign for your trading. And like he said, if that line starts trending down, it's not an opinion. It is a clear, objective signal telling you that you need to cut back and figure out what's wrong.
And that really leaves us with the one question that trumps everything else. In the heat of the moment, when you're on that amazing winning streak and your ego is screaming at you to go bigger, or when you're in a deep hole and desperation is telling you to make it all back in one trade, in that moment, who wins? Is it your discipline or is it your ego? The answer to that question, day in and day out, is what will ultimately decide your fate as a trader.
Welcome to The Explainer. You know, we're about to pull back the curtain on the one thing, the single most important principle that really separates legendary traders from, well, from everyone else. And it's probably not what you think. It's not about finding that perfect home run trade. Nope. It's about one thing: survival. So let's just start with this idea from Paul Tudor Jones, who is, one of the greatest traders of all time. Don't focus on making money. Focus on protecting what you have. Think about that for a second. It's so counterintuitive, right? It just completely flips the script on what we're all taught trading is supposed to be about. It's not about being the best attacker. It's about having the best, most impenetrable defense.
All right, so here's how we're going to break this all down. First, we'll tackle the #1 rule of trading that almost everyone gets wrong. Then, we'll talk about knowing your exit before you even get in. After that, we'll cover the right way to use a stop loss. Then we'll zoom out and look at risk from a portfolio view. And finally, we'll get into the trader's mindset, the psychology that really holds it all together.
Okay, let's jump right into part 1. The #1 rule of trading. And trust me, it's not what most people think it is. This right here, this gets to the absolute heart of it. See, beginners, they're totally obsessed with one thing: finding that magic entry point, right? That one signal that's going to make them a fortune. But the pros, the market wizards, they're playing a completely different game. They are relentlessly, obsessively focused on controlling their risk and protecting their capital. That's job number 1, 2, and 3. And this is such a profound truth. Think about it. Your survival in the market, your long-term success, it really depends way more on your defense than your offense. You could have a mediocre way of picking trades, but if your money management is solid, you can actually succeed. But flip that around, you could have the most brilliant trading idea in the world, but if your defense is weak, one bad day, one unexpected move can just wipe you out. It's like having a star quarterback with no offensive line. It's a recipe for disaster.
Okay, so if it's all about defense, how does that actually work in practice? How do the pros know when it's time to just throw in the towel on a trade that's going against them? Well, veteran trader Marty Schwartz has this brilliant concept he calls the uncle point. And yeah, it's exactly what it sounds like. Remember being a kid wrestling with someone and they just keep twisting your arm until you finally yell, "Uncle?" That's the idea. Schwartz says you have to decide, before you ever get into a trade, the exact price where the pain is too much and they're just going to yell, "Uncle," and get out. No questions asked. It stops the bleeding, both financially and emotionally. And the legendary investor Bruce Kovner puts it even more simply. I know where I'm getting out before I get in. That's it. It's not a suggestion, it's not a guideline, it is a non-negotiable ironclad rule. You make the call with a clear head before a single dollar is at risk. So why is this rule so absolutely critical? It's simple, really. The moment before you click that buy or sell button, that is the last moment you have any real objectivity. The second your money is on the line, your brain just goes haywire. Hope, fear, greed, they all come rushing in and cloud your judgment completely. That pre-planned exit, that's your only defense against yourself when you're at your most vulnerable. And here's a fantastic real-world story that just drives this point home. The author of the book we're looking at was sure the German Deutschmark was about to just explode higher, so he went long. But, and this is everything, he immediately set his uncle point, his stop loss, right below the recent price range. Well, what happened? The market wiggled around, turned against him, and boom, it hit his stop. He was out for a small, totally manageable loss. And then, literally moments later, the floor fell out. The market completely crashed. That small losing trade that he planned for, he calls it one of the best trades of his entire life. Why? Because it saved him from a devastating loss and taught him, once and for all, that his first job wasn't making money. It was not losing money. All right, so we all agree setting a stop beforehand is crucial. But then why do so many traders who do use stops still end up losing money? Well, that brings us to a really common and really expensive mistake. I mean, think about this for a second. How is it possible to be totally right about where the market is going and still lose money? It's one of the most frustrating things in trading, and it leads us perfectly into the story of hedge fund manager Colm O'Shea's first ever trade. So get this, O'Shea's analysis was perfect. He called it. He knew UK interest rates weren't going up, and he was 100% correct. But he lost money. How? Because he was so scared of being wrong, so afraid of losing, that he put his stop loss way, way too tight. Just the normal, everyday noise of the market, the little random up and down wiggles, kept knocking him out of his trade for a small loss, again and again. His big picture idea was a winner, but his risk was based on fear, not on his actual trading idea. And what O'Shea learned from this was to completely flip the process around. Here's the professional way to do it. Step 1. You look at your chart and you find the exact price where your trading idea is just wrong. That spot on the chart that proves your thesis is invalid. That's where your stop goes. Step 2. You decide how much money in dollars you are willing to risk on this idea. And then, and only then, step 3, you use those first 2 pieces of information to calculate how big your position size can be. So look at the difference here. It's night and day. The pros start with the logic of the trade to set their stop. The common mistake? People start with how big of a position they want to have. Then they figure out how much pain they can stomach, and they just kind of stick the stop there based on that feeling. But here's the thing. The market couldn't care less about your personal pain threshold. It only cares about price.
All right, now let's zoom out a little bit. We've talked about a single trade, but how do these principles of survival apply when you're managing a whole portfolio of trades?
Okay, just look at this number from the firm Blue Crest Capital. For 13 years, they made over 12% a year. That's great, but the incredible part? Their biggest loss from a peak, what we call a drawdown, was less than 5%. That is, honestly, that's just an insane level of performance with such a tiny amount of risk. It's almost unbelievable. So how in the world did they pull that off? Well, their secret was a super rigid, rules-based system. It was simple. Every trader had a hard limit. You lose 3% of your capital, bam, your trading account gets cut in half, instantly. You lose another 3% on that smaller amount, that's it. You're benched for the rest of the year. This super strict structure made it mathematically impossible to have a huge loss. But the really clever part is, as traders made money, their risk limits would grow, so they could take bigger swings, but only with their winnings. It's all about protecting the initial capital at all costs, while letting the profits run.
And I love how Blue Crest's founder, Michael Platt, puts it. He says the whole point is just to be there when the really great trade comes along.
Because if you take a big loss, it's like having your gun unloaded right when a giant elephant walks by. That elephant is the one trade that can make your entire year. So by not taking big losses, you make sure you've always got ammo ready for when the real prize shows up.
Now, if that whole blue crust model sounds a little complicated, Trader Larry Height boils the entire philosophy down to this one beautiful, simple sentence. Never risk more than 1% of total equity on any trade. That's it. By sticking to that rule, the outcome of any single trade just doesn't matter that much. It makes it so if you get stopped out, the damage is so small it's basically a rounding error. It means no single trade can ever take you out of the game.
Okay, last section. Let's talk about the inner game. Because you can have all the best rules and systems in the world, but if your head's not in the right place, none of it matters. At the end of the day, risk management is a battle you fight right between your own ears. So let's imagine this scenario, because every trader on the planet has been here. You're in a trade. It's losing money. The red numbers are getting bigger on your screen. But you still believe in the idea. You're sure you're right. So what do? Do you hang on? Do you get out? It's that moment of conflict that causes so many people just freeze up, totally paralyzed, while the hole just gets deeper and deeper.
Well, the pros have two really simple, really brilliant ways to break that paralysis. First, Steve Cohen's advice: if a trade is moving against you and you're confused, just sell half of it. Right away, that cuts the stress in half, it shrinks the problem, and suddenly you can think clearly again. Or Michael Marcus's advice is even simpler. When in doubt, get out. Just get flat. Liquidate the position, get a good night's sleep, and come back tomorrow. If the idea is still good, you can always get back in.
So that leaves us with one final big question that I want you to ask yourself. Is your current strategy built to make money, or is it built to survive? Because what we've learned from all of these market wizards is that the real secret isn't some magic formula for finding winners. It's a total mindset shift. It's about making your number one job, your absolute obsession, protecting the capital you already have. Because at the end of the day, in the markets, a strategy that's built for survival is the only one that ever really wins.
All right, today we're going to break down what might just be the single most important trade for success, especially when the stakes are incredibly high. And we're not just going to talk about theory. Oh no. We're going to dive into a gripping, true story of two trades made by the same man 10 years apart with two wildly different outcomes.
So, what is it? What's that one thing that separates the legends from everybody else? You've probably heard the word a million times: discipline. But what does that word really mean when millions of dollars are on the line and every single instinct in your body is screaming at you to do the exact wrong thing? Well, that's the question we're going to answer today through one man's unbelievable story.
Okay, let's get into it. Our main character on this journey is a trader named Randy McKay. And what's so fascinating about him is that he wasn't some kind of natural genius or an Ivy League whiz kid. Nope. He was a guy who learned the most important lessons in the most brutal way you can imagine.
And just look at this. This perfectly shows how unconventional his path really was. In 1968, he completely flunks out of college. And I'm not talking about by a little bit. We're talking 6 Fs. Right after that, he gets drafted into the Marines. When he finally gets back, he starts at the absolute bottom rung of the trading world, as a runner on the floor of the Chicago Merc. I mean, this is not the resume you'd expect for a market legend, right?
But from those very humble beginnings, he somehow developed this amazing knack for trading and, way more importantly, a reputation for one specific thing: ironclad discipline. And in 1978, that discipline was about to be put to the ultimate test, in a moment that would define the entire first half of his career.
So now we get to what I like to call the $1 million save, because what, on the surface, looks like a complete and total failure is actually one of the greatest examples of emotional control and rule-based thinking you will ever see.
So here's the setup. It's November of '78. The US dollar has been taking a beating all year long. Then, over a weekend, with zero warning, the Carter administration drops a bombshell, a huge plan to prop up the dollar. The market is caught completely, totally off guard.
And where was our guy Randy McKay in all of this? Well, he was heavily long the British pound, which was basically a massive bet against the US dollar. So when the market opened that Monday morning, it was an absolute bloodbath, a complete free fall going directly against his position.
So while the futures market was basically frozen, McKay didn't hesitate. He didn't wait. He went straight to the interbank market and liquidated his entire position, immediately. The cost of that split-second decision? A cool $1.5 million.
And you have to understand, at that time, that was by far the largest loss he had ever taken in his entire career.
So, let's just pause here for a second. He lost a fortune. By any normal measure, this is a complete disaster. But here's the twist. Why was taking this massive, painful loss absolutely 100% the right move? And why is this story told as an example of incredible success, not failure?
Well, this right here, this reveals his core philosophy, his one unbreakable rule. He said, "When I get hurt, I get the hell out." He believed that once you take a big hit, your judgment is shot. Your decisions become emotional, not objective. So the rule wasn't about outsmarting the market. It was about removing his own compromised self from the equation, instantly. No questions asked.
So McKay had his rule. He had proven it worked under the most extreme pressure imaginable. But what happens when, just for a moment, you break your own cardinal rule? Well, we're going to fast forward 10 years to 1988 to find out.
The stakes could not have been higher. McKay is right on the verge of his ultimate career goal, hitting the $50 million mark. He's in a massive position. We're talking 2,000 contracts long the Canadian dollar. But he's distracted. He's in Jamaica, supervising construction on a new house, and, this is crucial, he's in a big rush to get to the airport to catch a flight.
Just before the limo is about to take him to the airport, he glances at the quote screen, just to check on his position. And what he sees makes his stomach just drop to the floor.
The Canadian dollar is down exactly 100 points. Now, just for some context, a 20-point move overnight was considered rare. 100 points was basically impossible. So he's facing this critical choice. Is this just a glitch in the data, a simple bad quote, or is this a real unfolding disaster?
In this one moment of pressure, the mental trap of convenience just snapped shut. Because he was late, because it was easier, his mind rationalized. He told himself it must be a bad quote. But the reality? A shocking political poll had just dropped in Canada, throwing the election into chaos and sending the market into a full-blown panic. He chose the easy explanation over the disciplined one.
And you can see here how this one small lapse just snowballs into an avalanche. He rushes for his flight, actively ignoring that giant red flag. He gets to his new house in Jamaica. The phones haven't been installed yet. He has to drive to a hotel and then wait in line to use a payphone. And with every single second that ticks by, the financial damage is compounding. By the time he finally gets through to his clerk, the position is already down $3 million.
And that brings us to the brutal climax of this story, the final, painful invoice for that momentary lapse in judgment. This is the $7 million lesson. He manages to get out of a part of the trade, but the currency just keeps plunging. A few days later, when he finally liquidates the whole thing, his total loss isn't $1 million, it's not $3 million, it's $7 million. All because he broke his own number one rule. When I get hurt, I get the hell out.
Let's just put these two trades side by side to really see the lesson here. It's almost unbelievable. In '78, he faces a huge, unexpected market gap. His action? Immediate. His mindset? Objective and rule-based. The outcome? A contained $1.5 million loss. 10 years later, he faces the exact same scenario, but this time, his action was to rationalize and delay. His mindset was emotional and all about convenience. The outcome? A magnified, catastrophic $7 million loss. The only variable that changed was his discipline. That's it.
So what does this incredible, painful story mean for us? Even if we aren't big-shot currency traders? This is where we really get to the core of it all, your moment of truth. The ultimate moral from Randy McKay's career is simple and it's unforgiving. The market, or your career, or your life, whatever your market is, it will not let you get away with it. It will find the flaw in your process, it will exploit even a tiny, momentary lapse of discipline, and the consequences will be swift and they will be severe. Your own environment, whatever that may be, is always going to test your rules. It's going to present you with a situation where it's just easier, more convenient, or more comfortable to ignore the warning signs. So the question I really want to leave you with is this. When your moment comes, and it will come, what will it cost you to ignore the signs? When the stakes get really high, when the pressure's on, what's our first instinct? We look around for help, right? We look for an expert, for some kind of guidance. But what if the single most important voice to listen to is actually your own? We're about to get into a really powerful and true story about conviction, doubt, and an incredibly expensive lesson in why you just have to learn to think for yourself.
This quote right here from the legendary trader Michael Marcus, this isn't just some nice, fluffy sentiment. For traders, it's pretty much the first law of survival. You have to follow your own light. It sounds so simple, doesn't it? Almost like a cliche. But what really happens when that light, your own clear judgment, gets challenged by someone you deeply respect, someone who is, by pretty much every measure, way better at the game than you are.
All right, so Section 1, the core principle. For the best traders in the world, this is not just a suggestion. It's literally the line between making it and going bust. It really all comes down to owning every single one of your decisions, for better or for worse.
So what's the actual logic here? Well, think about it like this. When you stick to your own game plan, you know it inside and out. You know its strengths, its weaknesses, you know exactly when it's about to break. But the second you try to bolt on somebody else's opinion, you create this weird hybrid monster. You end up taking their idea for when to get in, but you use your own rule for when to get out, and that complete mismatch almost guarantees you get the absolute worst parts of both strategies, not the best.
Okay, Section 2, a story of conviction. Theory is one thing, but nothing makes a lesson stick quite like a real story. And we are about to walk through exactly what happens when this core principle gets thrown out the window. The way this all unfolds is so perfect, it honestly feels like it's made up, but I promise you, this is exactly what happened.
So to really get the decision that's about to be made, you have to get inside the guy's head. The author of this story was not feeling good. He was in a slump, a bad losing streak, and he'd cut back almost all of his positions. He was feeling vulnerable, second-guessing every move, which, as you know, is a really dangerous headspace for any decision maker to be in.
But in the middle of all that doubt, he had one and only one really strong conviction. He thought he should be shorting the Japanese yen. He saw this classic pattern on the chart, a huge, sharp drop, and then the market just coiled into this very tight, quiet range. To a trader, that coiling action is a huge signal. It's like the market is building up energy, like compressing a spring, getting ready for another massive move in that same direction. This was his analysis. This was his light.
So, Section 3, the voice of doubt. And this is where the story takes a sharp turn. Right at the moment he has this one crystal clear conviction, an outside voice pops up, and believe me, it's not just any voice. It's one that carries an immense amount of weight. The phone rings, and on the other end is one of the market wizards from that famous book. I mean, a trader who is light years more successful than our author. And the weirdest part, this legend is calling to ask for his opinion on the markets. It was just baffling. He's thinking, is this a prank? Is he just calling to do the exact opposite of whatever I say? It was such a confusing and intimidating way to start a conversation. So our author lays out his simple case for why the yen is going lower. And in response, the market wizard just unleashes this absolute fire hose of counter-arguments. He starts rattling off terms like oversold oscillators, which are basically just technical indicators that suggest the yen had fallen too far, too fast, and was due for a bounce. It was just an overwhelming technical assault on his one clear idea, and it was coming from a source he respected maybe more than anyone.
Okay, now I want you to put yourself in his shoes for a second. You're already in a slump. One of the best traders on the planet just gave you like 58 reasons why your only big trade is dead wrong. And to top it all off, you have to leave town that afternoon for a few days. You won't even be able to watch the markets. So what do? Do you trust your gut, or do you fold?
Now, before we see what he did, we have to talk about this psychological trap, rationalization. It's that clever little voice in your head that is an expert at making a bad decision feel like a really smart one. It takes an emotional impulse, in this case pure fear and doubt, and it just wraps it up in a nice cozy blanket of seemingly logical reasons.
And yup, that's exactly what happened. He rationalized. He started thinking, well, I haven't been doing that well. Do I really want to bet against one of the best traders I know, especially when I can't even watch the trade? So against his own gut feeling, against his own light, he just closed the whole position out. And this part just brilliantly illustrates how flawed his thinking was. The whole excuse about not being able to watch the market, it was just that, an excuse. He didn't need to watch it. He could have just put in a simple protective stop-loss order. That would have totally defined his risk and let his original idea play out without him even needing to be there. But, fear and doubt had already taken over.
So, Section 4, the aftermath. The decision's been made, the position is closed, but the story is not over, not by a long shot. This is where the real lesson and a fantastic twist is waiting.
So a few days go by. He gets back from his trip, heads into the office, sits down at his desk to check on the markets. What do you think he saw?
The Japanese yen had absolutely cratered. It had fallen hundreds of points, exactly like his initial analysis predicted it would. His one strong conviction, the one trade he let himself get talked out of, was a massive, massive winner. He was right all along. And he made exactly zero.
And as if to just rub salt in the wound, on that very same day, the phone rings again. It's the expert trader. He gets right to it and asks about the yen. Our author, trying to play it cool, says, "Oh yes, the yen. Are you still long?" Referring back to their last conversation where the expert was so bullish.
And here it is, the punchline. The expert just exclaims over the phone, "Long? I am short!" And this is the crucial twist. The very same person who gave him 58 reasons not to be short the yen was now short the yen himself, and had just made a boatload of money on the exact move our author had predicted from the start. How in the world is that even possible?
Okay, Section 5, the moral of the story. Why you have to follow your light. This is really the heart of the lesson. It's this wild paradox. Our author was right and made $0, while the expert was technically wrong but made a huge profit. The key to understanding this is realizing they were playing two completely different games.
Let's really break this down because this is so critical. Look at the time frame. Our author was thinking in weeks. He was trying to hold on for a major move. The expert, he was an intraday trader. He was thinking in minutes or hours. Their strategies couldn't have been more different. The author wanted to capture a big trend. The expert was just looking to scalp a tiny little bounce. So what actually happened? The expert went long for that quick bounce. It didn't work out, so he instantly flipped his position and went short, catching that huge wave down. He was nimble, he was flexible. Meanwhile, our author was totally right about the big picture, but he let an incompatible short-term opinion completely wreck his own plan.
So here is the crucial takeaway. The expert's opinion wasn't necessarily wrong. It was just wrong for the author. It was based on a totally different time frame, a different tolerance for risk, a different strategy. Trying to apply that short-term opinion to his long-term trade was like trying to use a map of New York City to navigate the streets of Tokyo. It was just doomed from the start.
And that brings us right back to where we started. This story is just the perfect, if pretty painful, illustration of why you absolutely must follow your own light. You cannot successfully manage your money using someone else's brain, their time frame, or their stomach for risk. Your system, your judgment, that's the only thing you can truly rely on because it's the only thing you truly understand.
And look, this lesson goes so far beyond the trading floor. In our careers, in our relationships, in our biggest life decisions, we are constantly just bombarded by the opinions of experts and friends and family. So the final question I want to leave you with is this. When it really truly matters, are you making decisions based on your own analysis, your own conviction, or are you letting some incompatible opinion from the outside lead you astray? Whose light are you truly following?
You know, what if I told you that for the world's most elite financial traders, confidence isn't just, a feeling, it's their single greatest asset? We're about to dive into a mindset so powerful, it completely redefines what risk and reward even mean. It's all based on this idea of ultimate confidence, and we're going to see just how far the best in the business are willing to bet on themselves. All right, so here's our roadmap. First, we'll meet the all-in investors. Then we're going to push beyond 100% to see what ultimate commitment really looks like. After that, we'll reframe our entire idea of risk with a matter of perspective, before getting into this powerful feedback loop called the confidence virtuous cycle. And finally, we'll wrap up by asking a pretty important question for all of us. Are you ready?
So let's just kick things off with a foundational question. When the folks who manage billions of dollars for other people go home at night, where do they put their own cash? Well, the answer is kind of shocking, and it tells you everything you need to know.
I mean, think about it. With access to literally every investment you can imagine, where do they put their own skin in the game? Where do they go for maximum safety and growth? Well, the answer isn't in some financial textbook. Nope, it's way more personal than that. And this right here, this is the core of it. For these guys, all that talk about diversification is pretty much irrelevant. Their unwavering belief in their own ability is the entire financial strategy. They don't just back their ideas with research, they back them with their entire financial existence. Let's get specific. These are the words of the legendary futures trader Paul Tudor Jones. Someone asked him where he keeps his own money, and his answer was simple: in his own funds. And his reason? He genuinely believes it is the safest place on planet Earth for his wealth.
Not kinda safe, the safest.
And he was not exaggerating, not even a little bit. Paul Tudor Jones invests a staggering 85% of his personal net worth right back into his own trading funds. Now, this goes way beyond eating your own cooking. This is like building the farm, raising the animals, and cooking the meal yourself because you simply do not trust anyone else's process more than your own.
But, as extreme as 85% sounds, that's not even the ceiling. Because another super successful trader, a guy named Monroe Trout, he saw that number and basically decided to one-up him.
Yep, 95%. Monroe Trout keeps 95% of his personal cash in his own funds. I mean, at this level, we are talking about near total commitment. It's a belief system where the biggest risk he could possibly take would be to not have his money under his own control. But what happens when even 100% of what you have isn't enough?
Okay, this is where the story shifts from just extreme confidence into a place that, honestly, most people would find completely unthinkable. We're about to meet a trader who was so sure of his strategy that he invested more money than he actually had. So get this. In his early years, a trader named Gil Blake didn't just invest his net worth. He leveraged his home, his main asset, 4 separate times over 3 years. As the value of his house went up, he kept taking out second mortgages, not for a new kitchen, but to pour that borrowed money directly into his trading account. He was, quite literally, betting the house.
And Blake was totally aware of how insane this looked to everybody else. He even said that when you tell people you're doing this, the feedback is, well, it's not exactly encouraging. He said he eventually just stopped telling people because he didn't need their approval or their doubt.
And this is the absolute key. For Gil Blake, there was zero hesitation. It wasn't a gamble in his mind. And why? Because he believed the mathematical odds of his trading strategy were so overwhelmingly stacked in his favor that borrowing money to press that advantage was the only logical move to make.
So this brings us right to the heart of it, doesn't it? How can one person's idea of just reckless gambling be another person's definition of absolute safety? Well, it all comes down to a massive difference in perspective, and it's shaped by one thing: confidence. What's so fascinating here is how you can look at the exact same action, investing 95% of your net worth or taking out mortgages to trade, through 2 totally different lenses. The conventional view, it sees pure recklessness. It goes against everything we're ever taught. But from the trader's point of view, it's the peak of safety and logic. And this is the big takeaway. For these traders, the biggest risk they could take is giving their money to forces they don't control or understand as well as their own methods. So, investing in themselves isn't about ego, it's about security. Their confidence literally changes how they see the world.
So, this all leads to that classic chicken or the egg question. Is this incredible confidence the cause of their success, or is it just the result of it? Well, the answer isn't quite that simple. It's not a one-way street.
So which one is it, right? Does the confidence have to come first, fueling those huge actions that lead to success? Or does a history of success slowly build that confidence over time? Turns out, it's not one or the other. It's both. It's this powerful feedback loop, a virtuous cycle. It might start with just a seed of confidence, enough to let you take a bold, decisive action, like committing a huge chunk of your capital. Then, when that action pays off, that success gives you more than just profit. It gives you this massive injection of reinforced confidence. And that makes the next bold decision even easier. Each part feeds the other, creating this incredible upward spiral.
Okay, so how does this extreme bet the house mindset apply to the rest of us? Well, this whole framework gives us a really practical, if kind of unforgiving, litmus test to figure out our own level of conviction in, well, anything, whether it's trading, starting a business, or even learning a new skill.
So let's bring this all back home. Forget about 95% for a second. How do you know when your own belief in your strategy or your ability is strong enough? When is it the real deal? According to these traders, the answer is deceptively simple. When you get there, you just know. But if you're not sure, here are some really clear warning signs that you haven't hit that level of absolute confidence yet. If you feel, deep down, unsure about your strategy, if you find yourself constantly asking other people for their opinions, or if you hesitate when it's time to actually commit resources, whether that's time or money, then you're not there yet.
I love this because it's so simple. Think of it this way. Confidence, at this level, is binary. It's on or it's off. There's no dimmer switch. There's no, I'm pretty sure. In this world, any feeling of uncertainty is a stop sign. It's a clear signal that you've got more work to do.
And that leaves us with one last thought to chew on. You know, it's really easy to look at Gil Blake's second mortgages and just call it risky. But what if he was right? What if his confidence was so well-founded that not taking out those mortgages would have been the riskier move because it would have meant leaving a life-changing opportunity on the table? So think about your own goals. What risk in your life is only a risk because you lack absolute confidence? You know, what if I told you that the real secret to winning isn't about trying to avoid losses? It's about learning how to embrace them. Yeah, I know, it sounds totally backwards, right? But in high-stakes worlds like professional trading, the number one thing that holds people back is their fear of losing. So today, we're going to dig into why getting good at losing is maybe the most important skill you can have to actually win. All right, here's the game plan. First, we're going to uncock this weird paradox between winning and losing. Then, we'll look at the ego trap that catches almost every beginner. After that, we'll see how the pros think, which is totally different. We'll introduce a new way to think about your trades, and finally, wrap it all up with how to actually embrace your mistakes and use them to succeed. Okay, let's dive right into the core idea here. This is the fundamental thing that separates the absolute best from, well, pretty much everyone else. It all comes down to this. Trying not to lose is actually a losing strategy.
I really want you to sit with this for a second. It goes against everything we're taught, doesn't it? That losing is failure. But what if, in some games, losing is just a normal, expected part of the journey to winning? And here is the great irony of it all. This is the psychological trap. Amateurs are so focused on not losing the small battles that they end up losing the entire war. Their fear of taking a tiny, manageable loss makes them hold on until that small loss turns into an absolute disaster. So let's get specific. Let's talk about the single most destructive thought process for a beginner. It's all about the ego, and it's driven by that desperate little voice that says, I just want to get back to even. This quote from the legendary trader Marty Schwartz just nails it. We've all been there, right? Whether it's the stock market, a poker game, whatever, that little phrase, I'll just get out when I'm even, sounds so reasonable. But he calls it what it is, the ultimate rationalization. It's a total trap. So what's really going on in our heads when we say that? Well, it's not about the money anymore. It's about ego preservation. It's about our need to not be wrong. If you get out even, you get to tell yourself, see? No harm, no foul. I didn't really make a mistake. But protecting your ego like that can be a terrible financial decision. And this was Schwartz's big aha moment. This was the breakthrough. He made a conscious choice. He decided to just say, to hell with my ego. Making money was more important than being right. That's a huge shift. He realized that making good decisions for the long run was the only thing that actually mattered. Okay, so that's the amateur mindset, and it's all based on fear. So what's the alternative? Let's flip the script and dive into how the professionals think. It's all about having total confidence in your process. This is a complete paradigm shift. Now, get this quote from another legend, Linda Raschke. At first, you might hear that and think it sounds, I don't know, a little arrogant, maybe? But it's actually the exact opposite. This is a statement of incredible confidence. But it's not confidence in her ability to predict the future. It's confidence in something way more powerful. See, this is what she's really saying. Her confidence isn't about one single trade. It's about her entire system, her whole process. She knows, over time, that her method has an edge. So a single loss, it's not a failure. It's just a data point. It's an expected cost of doing business on her way to winning overall. And hey, this isn't just a couple of cool anecdotes. This is a well-documented psychological pattern. A research psychologist, Dr. Van Tharp, basically dedicated his career to figuring out what makes the best traders tick, and he found they all share a set of core beliefs. And what he found was crystal clear. 2 beliefs just shot to the top. First, the best of the best all agree. It is totally okay to lose money. And second, get this, they feel like they've already won the game before they even place a trade. How is that even possible? Because they trust their process. They have a game plan, and they know that a loss here or there is just part of that winning plan. Okay, so you're probably thinking, this all sounds great, but how do I actually start thinking this way? Well, this next part is a really practical tool. It's a mental framework that can completely change how you look at your decisions.
See, most of us live in a black and white world. A trade is either a winner or a loser. That's it. But the pros, they see things in a much more nuanced way. They know there are actually 4 outcomes, because good and bad are totally separate concepts from winning and losing. This is so important. You can have a good trade that loses money, and you can have a bad trade that gets lucky and wins. This little table makes it super clear. A good trade is any trade where you followed your rules, you followed your process. Sometimes you get paid for it. Other times you take a loss, but it was still a good trade. A bad trade is when you break your rules, when you gamble. Yes, sometimes you might get lucky and win, which is super dangerous because it teaches you bad habits. And other times you get what you deserve. The entire goal of a professional is to live only in that top row. To really make this stick, let's try a simple analogy. Imagine I walk up to you and offer you this bet. We'll flip a coin. You can use your own coin. Totally fair. If it lands on tails, I give you $200. If it lands on heads, you give me 100. You take that bet every single time, right? The odds are massively in your favor. So you take the bet, you flip the coin, and it lands on heads. You just lost $100. So let me ask you, was that a bad bet? The answer is absolutely, positively no. It was a fantastic bet that just happened to have a negative outcome this one time. If you took that bet 100 times, you'd be rolling in it. And this is the whole point. You have to learn to separate the quality of your decision-making from the random outcome of any single event. Okay, so let's tie all of this together. We get the psychology, we have the new mental framework. How do we actually put it into practice and start walking that professional path? I love this final quote from another trading giant, Bruce Kovner. It's just perfect. He's basically saying the road to incredible success is literally paved with being wrong. It's a cycle. You make a judgment, you're wrong, you take a small loss. You make another judgment, you're wrong again. And then you hit that one trade that doubles your money and makes it all worth it. So at the end of the day, the path forward really comes down to these 3 steps. First, you have to tame your ego. Your self-worth has absolutely nothing to do with one trade. Second, trust your process. Your job isn't to be right all the time. It's to make good bets consistently. And third, take your losses. Take them fast, take them without emotion. They're just the cost of admission to play a winning game. And that leaves us with one last question to think about, because this idea is so much bigger than just trading. Think about your career or your relationships or even just a creative project. Where else in your life could being a little more willing to accept small losses, to be wrong, to make mistakes, actually be the key that unlocks your biggest wins?
You know, in the world of trading, we're always told that speed is everything. You got to make quick decisions. You got to always be in the action. But what if that's completely wrong? What if the real secret to crushing it in the markets isn't about doing more, but about patiently doing a whole lot less? Well, in this explainer, we're going to tear down that myth and show you why patience isn't just some fluffy virtue. It is your single most powerful edge. And hey, don't just take it from me. Listen to Tom Baldwin, an absolute legend in the treasury bond pit. When someone asked him what the biggest mistake traders make is, he didn't talk about fancy algorithms or some secret formula. Nope, he pointed to something much, much simpler: a total lack of patience. And honestly, that one idea is the key to everything we're about to dive into.
So, how do we get this skill? Well, we're going to tackle it in 5 parts. First, we need to really understand the problem, what we'll call the Wall Street fool. Then, we'll get schooled by the true masters of the waiting game. After that, we'll check out some hard data that actually proves the incredible power of just doing nothing. We'll also flip the coin and explore the other side of patience, sitting tight when you've got a winning trade. And then, at the end, we'll wrap it all up to give you a completely new way to think about your own trading.
All right, let's get into it. Part 1. The Wall Street Fool. See, to fix any problem, you first have to get to the root of it. And this constant itch to be in a trade, it's not a new thing. It's a timeless human flaw that traders have been wrestling with for like over 100 years. Just think about this for a second. All the way back in 1923, this book laid out the exact psychological traps that traders are still falling into right now. Today, we've got supercomputers and AI and instant information, but the fundamental human mistakes, they haven't changed one bit since the days of the old ticker tape.
And this quote just nails the distinction perfectly. Look, there's your average fool who just makes mistakes everywhere. But then there's the Wall Street fool. And what's their big sin? They think they have to be trading all the time. It's not even about making bad calls. It's the sheer compulsion to always be doing something, anything.
So why? Why do we do this to ourselves? Well, here's the trap. We start treating trading like it's a regular 9-to-5 job. We get this feeling that we're supposed to clock in and take home a paycheck from the market every single day. But guess what? The market doesn't care about your schedule. And that one misunderstanding is an absolute recipe for disaster.
Okay, so if the disease is overtrading, then what's the cure? It's learning how to wait. And to do that, we're going straight to the top. We're going to learn from the legends who built empires not by being busy, but by being incredibly patient.
I absolutely love this quote from Jim Rogers. He's not out there trying to scalp a few pennies here and there. No, he's a hunter. He waits and he waits for an opportunity that is so good, so obviously a winner, that it feels like he's just finding a bag of cash sitting in the corner. If it's not a total layup, he is just not interested.
And then there's Warren Buffett, who uses this perfect baseball analogy. See, in a real game, if you don't swing, the umpire can call you out on strikes. But in the market, there are no called strikes. You can stand there and watch thousands of pitches, thousands of trade opportunities fly right by you with zero penalty. Your only job is to wait for that one perfect, fat pitch right down the middle before you swing for the fences.
Now let's take a trip to the animal kingdom with Mark Weinstein. A cheetah, right? Fastest animal on the planet. But it doesn't just waste energy sprinting after every single gazelle it sees. No way. It waits. It stalks. It saves all that incredible power for the perfect moment, when the prey is vulnerable and the chance of success is practically 100%. That is professional trading.
And if you're thinking, okay, this is all just some nice-sounding philosophy, well, take a look at this number. Ed Seykota, a true pioneer of trading systems, pulled off a return of 250,000%. How on earth did he do that? One of his core rules was having the patience to ride a trend for as long as it would run.
So how did he keep that kind of discipline? It's so simple. It's brilliant. He just got rid of his quote machine. He literally removed the temptation from his desk. He knew that watching every little price tick is exactly like having a slot machine sitting right in front of you. It just begs you to pull the lever, to take a gamble, and to completely wreck your well-thought-out positions.
All right, so we've heard from the legends. Now let's look at the cold, hard data. Because this isn't just a philosophy, it's a real, quantifiable edge. We're about to look at a case study that proves the absolutely insane power of doing, well, nothing at all.
Let's just start with this number, 872%. That's the return a trader named Kevin Daly pulled off over an 11-year period. I mean, just an incredible performance. But how he did it, that's the real story here.
Now look at this in context. He got that massive return during a time when the overall market was just awful. The Russell 2000 was barely up, and the S&P 500 actually lost money over that same stretch. So how in the world did he outperform by such a ridiculous margin?
And the answer is so simple, it's profound. He made his money on the trades he didn't make. I mean, talk about bad timing. He launched his fund right before the dot-com bubble burst. But instead of trying to fight his way through it, he had the patience to just sit in cash. While everyone else was getting absolutely crushed, he protected his capital. He basically sidestepped 2 massive crashes, and that made all the difference.
But listen, patience has 2 sides. It's not just about waiting for the perfect moment to get in. It's just as important, and it might even be harder, to have the patience to stay in once you're in a winning trade.
I'm sure you've heard this a million times, right? You can't go broke taking a profit. It sounds so safe, so sensible. It's one of those pieces of advice that just seems impossible to argue with.
But what if it's completely and utterly wrong? The legendary trader William Eckhart argues that's exactly how professionals do go broke. He says amateurs get wiped out by taking giant losses, but professionals, they die a death by 1,000 cuts, taking tiny little profits and never letting a winning trade run long enough to pay for all their little mistakes.
So why is it so hard to let our winners run? It comes down to psychology. It's the same exact reason slot machines are so addictive. It's a principle called intermittent reinforcement. Getting small, unpredictable rewards just feels good. You take a small profit, you get that little dopamine hit, and that reinforces the terrible habit of selling way too early.
And this brings us right back to Jesse Livermore, one of the greatest to ever do it. He famously said that the big money didn't come from his thinking. No, it came from his sitting. Being right about the direction was the easy part. The hard part
The part that actually made him a legend was having the guts and the patience to just sit tight and ride a trend all the way.
Okay, let's pull all of this together now. What we really have are two sides of the same powerful coin: the patience to wait for the perfect entry and the patience to sit tight for the maximum profit. If you can master both of those, you've pretty much mastered the entire game.
The composer Claude Debussy once said, "Music is the space between the notes." It's not just the sounds themselves that make a beautiful song. It's the silence, right? The pauses in between. That's where all the rhythm and the emotion really come from.
And that is the perfect metaphor for what elite trading really is. Your success isn't defined by the constant chaos and flurry of activity, by just playing as many notes as you can, as fast as you can. No, it's defined by the quiet, disciplined, patient space between your trades. That's where the real magic happens. So I'll just leave you with this question to think about. Are you just frantically playing the notes, or have you finally learned how to play the music?
You know, from the time we're kids, we're taught that loyalty is this incredible virtue. And our families, friendships, our jobs, it's everything. But what if I told you that in the super high-stakes world of financial trading, that same loyalty is actually one of the most dangerous flaws you could possibly have? It's a weird, powerful idea, so let's explore it together.
I mean, it's a fascinating question, right? Think about it. The one thing we praise everywhere else in life, sticking to your guns, having conviction, that can become the recipe for absolute disaster when there are millions of dollars on the line. So, what do the world's greatest traders do instead? Well, let's find out. Okay, so the concept is called no loyalty. And look, this isn't about being unprincipled or flaky. It's about a radical kind of flexibility. It's this incredible discipline to completely detach your ego from your ideas. It means you can change your mind the instant the facts change, without even hesitating. And to really get our heads around this, we're going to dive into some absolutely incredible stories. We'll see exactly why loyalty can be a trader's worst enemy. We'll look at how the absolute best in the business pivot when the world changes on them. We're even going to see some decisions made under, catastrophic pressure, and one story of a truly ultimate reversal. Then, we'll see how this flexibility thing works right from the start, and, maybe most importantly, we'll uncover the big psychological barrier that stops most of us from doing it: our own ego. All right, let's kick things off with this core idea. Why does something we see as a virtue, loyalty, suddenly become a vice in the market? Well, it's because the market, it has no memory. It has zero loyalty to you. It couldn't care less about your brilliant opinion or how many hours you spent researching an idea. The market only cares about one thing: price. And it can turn on you in a heartbeat.
The legendary trader Michael Marcus just puts it perfectly. He says, "I am willing to take in information that is difficult to accept emotionally." And that right there is the key. That's what separates the greats from everyone else. See, it's not about being smarter. It's about being more adaptable. He can look at a trade that's losing a ton of money, one he had super high hopes for, and just say, well, that's not working, and boom, he's out. No second guessing.
And that brings us to our first couple of examples. We're going to see how two of the world's top traders did a complete 180 when new evidence popped up. Because look, the world is always changing, right? What was true yesterday could be totally false today. The best traders, they don't fight that. They embrace it. Let's see how they do it.
All right, take Colmo Shea back in 2009. After the huge financial crisis, his whole view was simple. The world is in just terrible shape. But then, the market started sending him these little signals that maybe he was wrong. China was starting to recover. Metal prices were ticking up. The Australian dollar was getting stronger. Now, instead of stubbornly sticking to his gloomy, the world is ending view, he actually listened. He basically asked himself, okay, what story fits these new facts? And the answer was an Asian-led recovery. This is a perfect example of no loyalty in action. He just ditched his old idea, completely reversed his thinking, and ended up having a great year, even though his original outlook was dead wrong.
And this next one really shows you the kind of speed we're talking about. In just 2 weeks, the legend Paul Tudor Jones went from being heavily short the stock market, betting it would crash, to being long, betting it would go up. The only evidence he needed was that the market just wasn't going down like he thought it would. So he didn't just get out of his bad trade. No, he took the exact opposite position. That is just an insane level of flexibility.
Okay, so we've seen how these guys pivot when the facts change. But what happens when there are no facts to look at? When it's just pure, raw instinct? Well, let's move on to a story where the stakes are even higher.
This is all about making a split-second decision when a total catastrophe strikes, and the only thing you have to go on is your gut.
Okay, so picture this. There's this trader, Michael Platt, and he has a massive, massive bet on European interest rates. Then, completely out of the blue, the European Central Bank hikes rates. It's a devastating blow to his position. But here's the worst part. Platt is on a long-haul flight. He is completely unreachable, totally cut off from the world as this disaster is unfolding. He is literally in the dark.
So the moment his plane touches down, he gets the call. His assistant is on the line, asking what to do. Platt's first question is simple. How much are we down? And the answer comes back, $80 million. Just like that. An absolute fortune vaporized while he was in the air. Platt's response? Just 2 words. Dump everything. That's it. No hesitation, no hoping for a miracle bounce back. His logic was just ice cold and clear. If the central bank just started hiking rates, more hikes are probably on the way. That $80 million loss could easily turn into a $250 million loss. As he put it himself, when I am wrong, the only instinct I have is to get out. I don't care what the price is. He knew he had to be the absolute first one to sell.
I mean, that story is incredible. But it brings us to what might be the single greatest example of no loyalty I have ever heard of. This one involves Stanley Druckenmiller, one of the greatest traders of all time and what is arguably the worst trading blunder in history. Seriously, this story takes the idea of no loyalty to a completely different planet.
So let's set the scene. It's Friday, October 16th, 1987. The market's already been sliding for weeks. Druckenmiller, who had been short, thinks, okay, this drop has gone far enough. So he covers his short position. But he doesn't just stop there. He goes all in, flipping to a 130% leveraged long position. Then the weekend hits, and this horrible sense of dread just washes over him. He realizes he has made a terrible, terrible mistake. And then comes Monday morning, Black Monday. The market opens in an absolute freefall. So what does he do? In the very first hour of trading, he sells every single share. And then he goes short. Again.
I mean, this is the ultimate example. You literally cannot imagine a worse mistake. He went leveraged long on the Friday right before the single biggest crash in modern history. But because he had zero, and I mean zero loyalty to that position, he was able to just eat the pain, completely reverse course in the middle of a full-blown panic, and save himself from total ruin. Get this, his results for that entire month showed only a moderate loss. It is absolutely mind-boggling.
So we've seen how this kind of flexibility can save you from a complete catastrophe, right? But it's not just a defensive move. It's also about how you find the best trades to begin with. And a lot of times, that means proving your own best ideas wrong before you even put a single dollar on the line. Let's take a look.
So check out this story about Jamie Mai. He has this great idea. China's demand for coal is exploding, so the obvious trade is to buy stocks of shipping companies. Makes perfect sense, right? But Mai is one of these guys who's incredibly thorough. And as he digs deeper and deeper into the research, he finds this one hidden fact. A massive fleet of new ships, ordered years ago, was about to hit the water. All this new supply was going to crush shipping prices. So what does he do? He completely throws his original idea in the trash. And in fact, he realizes the real trade here is the exact opposite, to bet against those shipping stocks. And that became his #1 highest conviction short trade of the year.
So if this strategy is so powerful, why don't more people do it? I mean, why do we so often cling to ideas that are clearly failing? Well, the answer is actually pretty simple, and it's our final topic, the danger of ego. Your ego is the #1 enemy of good decision-making. It is the reason why most people would have held on to every single one of those losing trades we just talked about. Paul Tudor Jones actually warns people about this all the time. He says, the moment you go out and publicly announce what you think the market is going to do, you've just set a trap for yourself. Suddenly, your ego's on the line. You're not invested in making money anymore, you're invested in being right. You'll start ignoring facts that prove you wrong, and you'll desperately search for any flimsy reason to justify your bad position. You're not objective anymore. You're trapped in a cage that you built yourself.
And what's really fascinating is how the trader Ed Seykota learned this lesson the hard way. See, he went and told all his friends he was super bullish on silver, and then silver started to drop. He saw all the warning signs that he was wrong, but he just ignored them. Why? As he admitted later, he said, I couldn't afford to be wrong. That is the polar opposite of no loyalty. His reputation in front of his friends felt more important than what the market was actually doing.
So his conscious mind was totally trapped by his ego, but his subconscious knew he was in big trouble. He started having these recurring nightmares of a giant silver airplane just spiraling down, heading for a crash. I mean, you can't get a more obvious metaphor than that, right?
His own mind was literally screaming at him to wake up and see the danger he was in.
And eventually, he got the message. He finally listened, he dumped his entire silver position, and he even went short. And the moment he did that, the nightmares stopped. See, by letting go of his ego and finally embracing no loyalty, he didn't just save his capital, he got his peace of mind back.
So this all brings us to the final, most important point, and it's summed up perfectly by this idea. Look, it's one thing to have the discipline to sell a losing trade when you know you're wrong. That makes you a good trader. But it takes a whole other level of mental toughness and a complete lack of ego to say, you know what? I was so wrong that the best move is to immediately take the opposite side of my own failed idea. And that is what separates the good from the truly great. That's the real power of no loyalty.
So as we wrap this up, I want to leave you with a question. This whole idea of no loyalty, yeah, it's super powerful in the markets, but it's really a tool for thinking that you can apply to just about anything. So I want you to ask yourself, is there an opinion, maybe a project, or even a path in your life that you're loyal to, just because, well, you've been loyal to it for a long time? What do you think might happen if you just decided to look at all the facts again with fresh eyes? What if a little less loyalty and a whole lot more flexibility could unlock a much, much better outcome for you? Something to think about.
You know, when we think about what really separates the amateurs from the true legends in trading, we usually focus on things like picking the right stock or calling the market's direction. But what if the real secret sauce, the professional's edge, isn't about what you trade at all, but about how much you trade? Today, we're going to talk about position sizing. It's this unseen force that can take a losing strategy and make it profitable, or take one single mistake and turn it into complete and total ruin.
So where are we getting all this from? Well, our guide for this deep dive comes from basically studying the playbooks of the absolute titans of trading. The insights we're about to unpack are pulled directly from their biggest wins, their most agonizing losses, and the lessons that, frankly, were beaten into them on their way to becoming giants in this business.
Okay, here's our game plan. We're going to start in a pretty unexpected place, a casino, to see where these ideas came from. Then we'll look at the catastrophic danger of getting your size wrong. After that, we'll get into the really juicy stuff, the counterintuitive advice on when to be hyper-aggressive, how to read the market weather, and then finally, how you can piece all this together to find the right size for your own trading. All right, so our story begins not on the chaos of a trading floor, but at a quiet blackjack table. It's about a math professor, a guy named Edward Thorpe, who figured out how to beat the casino and then realized he could use that exact same logic to absolutely conquer Wall Street.
Now just take a second and look at this number. I mean, really look at it. 227 winning months out of 230 over 19 years. That is just insane consistency. A track record like that isn't about getting lucky. It's not even just about picking winners. It points to something deeper, a mastery of risk and a mastery of sizing. So what was his big aha moment at the casino? Well, he realized that blackjack is designed to be a loser's game, right? The house always has an edge. But he figured out how to flip that edge. The key wasn't just knowing when he had good cards. It was betting big, really big, when the odds shifted in his favor, and betting tiny when they weren't. How much he put on the table was just as critical as the cards he was dealt.
And here is where it all clicks into place for trading. See, you can't know the exact probabilities in the market like you can in blackjack. But you can have degrees of confidence in a trade, and that's the key. The whole idea is to treat your trading capital just like casino chips. You risk a lot more on your absolute best, highest conviction ideas, and you risk a whole lot less on everything else. That one simple shift can totally transform your performance.
Okay, so we've seen the power. Now let's look at the flip side, the dark side. Because when this amazing tool is misused, it becomes the single fastest way to blow up your account. And this isn't just theory. This is a lesson written in the scar tissue of some of the greatest traders to ever live.
So let's set the scene. You've got a young Paul Tudor Jones, who would later become a legend. He's got a big position on 400 contracts in the cotton market. He's feeling good about it, you know? He thinks the market is coiled up and ready to explode higher.
And then he got a little cocky. He later called it bravado. He decided to really press his bet and threw in an order for another 100 contracts. And you know what happened? The instant his order filled, the market turned hard against him. He knew, right in that moment, he had made a huge, huge mistake.
And this is where it goes from a bad trade to an absolute nightmare. The market didn't just dip, it completely cratered. It fell so fast that it hit its maximum daily loss limit, and they just halted trading. It was locked limit down. Now imagine that feeling. You are trapped in a massive, hemorrhaging position, and you literally cannot get out. The sell button doesn't work. And for 2 straight days, all he could do was sit there and watch his account just evaporate.
So what was the final damage? 60 to 70%. Gone. Wiped out on one trade. I mean, just think about that. He lost well over half the money he was managing in a matter of days. The blow was so brutal, he honestly thought about just quitting trading for good.
And this quote he gave later, it just says everything. He's talking to himself, calling himself Mr. Stupid. That one traumatic trade completely rewired his brain. From that day on, his main goal wasn't how much money can I make, it was how do I protect what I have. Defense, defense, defense became his #1 obsession.
And he's not alone in this thinking. Another trading legend, Bruce Kovner, hammered this point home. He said that almost every novice trades 3 to 5 times too big. They're taking on so much risk that they're practically guaranteed to blow up eventually. So his advice became this famous rule of thumb. Whatever position size you think you should have, just cut it in half, at least.
Okay, so we've just spent all this time talking about defense, trading smaller, playing it safe, and now we're about to flip the script completely, because this is where it gets really interesting. The masters teach us that after all that defense, there are very rare moments when the right move is to do the exact opposite and trade absolutely huge.
So check out this story. Stanley Druckenmiller, who's a trading genius in his own right, was working for the one and only George Soros. Druckenmiller found a trade he was incredibly confident in, so he put on what he thought was a massive bet, a $1 billion short on the dollar. He's feeling pretty proud of himself. $1 billion is a big deal, right? And then he tells Soros about it, and Soros just looks at him and says, "You call that a position?" I mean, can you imagine? With just 5 words, Soros completely shattered his perspective. What Druckenmiller thought was a huge, aggressive move, Soros thought was, well, kind of timid. It just shows you there are levels to this game. And that was the lesson for Druckenmiller. It's not just about being right. It's about how much money you make when you're right versus how much you lose when you're wrong. Soros taught him that when you get one of those rare, high-conviction, maybe once-a-decade opportunities, your job is to go for the jugular. You have to be a pig and maximize it. All right, let's get into a more advanced idea. See, the pros don't just size their trades based on how confident they are. They are constantly looking at the overall market environment. You can think of it like checking the market weather. Is it calm and sunny out, or is there a hurricane on the horizon?
This table really breaks it down. When the market is quiet and volatility is low, you can afford to take on larger positions. But when things get chaotic and volatile, you absolutely have to shrink your size. And the math here is so important. One trader, Cole Moshe, pointed out that during the 2008 crisis, if volatility went up 5 times and you only cut your position size in half, you didn't reduce your risk, you actually more than doubled it. It's wild.
Okay, one last expert-level concept here. This one is huge. It's about understanding the hidden risk that creeps in when a bunch of your trades, which seem separate, are actually all connected and moving in lockstep. This goes right back to Edward Thorpe, the math genius. He understood that putting on 5 different trades doesn't mean you have 5 independent bets. For example, if you're long gold and you're also long silver, you don't really have 2 separate trades, right? Because they tend to move together. So you've really just made one big bet on precious metals. So what did he do? Simple. As you see here, he'd consciously take a smaller position in each of them just to make sure his total portfolio risk didn't get out of control.
All right, so let's try to wrap all this up. We've seen how sizing can create an edge out of thin air. We've seen how it can absolutely destroy you. And we've seen how the masters use it, playing extreme defense sometimes and then surgical all-out aggression at other times. So what's the big takeaway from all this?
Well, the main thing is that position sizing isn't some magic formula. It's a skill you have to develop. It's about knowing that how much you bet is an incredibly powerful lever. It's understanding that survival is everything, which means playing defense most of the time. But, and this is a big but, it also means having the guts to really step on the gas when you have a killer hand. And through it all, you're constantly adjusting for the market weather and for correlation. And maybe the most important part, trading within your personal emotional capacity. Find a size where you can still sleep at night, a size that doesn't make you so scared you can't think straight. So I'll just leave you with this one question to think about. The next time you're about to place a trade, before you click the button, just stop for a second and ask yourself, is the size I'm choosing a reflection of my analysis, or is it a reflection of my emotion? Is it greed talking or is it fear? The answer to that question might just tell you everything you need to know. Have you ever noticed that making the right financial decision often feels, well, just plain wrong? It turns out that our gut instinct, the very thing that helps us get through the day, can be our absolute worst enemy when it comes to money. So let's dive into why learning to embrace that uncomfortable feeling might just be the most profitable thing you ever do.
So here's what we're going to cover. We'll start with a kind of a wild idea about a monkey who's better at investing than you are. Then we'll look at a real-world experiment that accidentally proved this whole thing right. After that, we'll get into the science of why our brains are wired to make bad choices, see how even computers can fall into the same trap, and finally, we'll reveal your single biggest financial enemy.
All right, let's jump right into our first section. It's built around this idea from a trader named William Eckhart. And honestly, it's an idea that pretty much flips everything we think we know about being a smart investor completely on its head. You've probably heard this one before, right? This old saying about a monkey throwing darts at the stock pages in the newspaper to build a portfolio? It's usually just a jab at all the so-called experts. But what if it's more than just a joke? What if the punchline is actually on us? Now, most people know the common version from Burton Malkiel, that a monkey could do just as well as the pros. But here's where William Eckhart takes it a massive step further. He doesn't say the monkey will tie. He claims the monkey will actually do better. Yeah, you heard that right? Beat them. How on earth could that possibly be true? The whole entire argument really boils down to this one simple insight. Eckhart's point is that we, as humans, are just hardwired to seek comfort. We want to make decisions that feel good, that feel emotionally satisfying right now. The problem? The market does not care about your feelings. In fact, it often brutally punishes you for seeking comfort.
Eckhart has a name for this. He calls it the call of the countertrend. You know the feeling. It's that powerful urge to buy a stock when it's way down or sell it when it's way up. It feels so good, doesn't it? It feels smart. You get to tell yourself a story about how you're a genius for buying the dip or selling the top. It's a really satisfying narrative.
And you see this instinct in a few classic, costly ways. Buying a stock that's just hit a 6-month low feels like you're getting a fantastic bargain. Cashing in a small profit feels like a nice, safe win you can lock in. And of course, holding on to a losing trade feels way, way better than having to admit you were wrong and take the hit. In every single one of these cases, the comfortable decision is almost always the wrong one.
Okay, so that's a fascinating theory. But is there any actual proof? Well, as it turns out, a completely accidental experiment gave us some of the most stunning, real-world evidence you could ask for. So there's this investor, Joel Greenblatt, who came up with what he called a magic formula, basically just a system for finding good, high-value stocks. He was generous with it. He put a list of these pre-screened stocks online, and he gave people a choice. You can either go through this list and pick your own stocks, or you can just check a box and let us manage a portfolio for you automatically. 2 years later, they looked at the results, and they were absolutely staggering. The automatically managed portfolios, the ones with zero human decisions involved, outperformed the portfolios where people handpicked their own stocks by a whopping 25%. And get this, they were both pulling from the exact same list of pre-approved high-potential stocks. The only variable was the human touch.
So, what on earth happened? Greenblatt himself explained it perfectly. He said people actively avoided the stocks that were painful to own. You know, the ones that maybe looked a little scary or were volatile or had some bad news swirling around them. By choosing what felt comfortable and avoiding that pain, they systematically filtered out some of the biggest winners. Their decisions weren't just random, they were actually worse than random.
This all just begs the question, why? Why are we so predictably bad at this? Well, the answer lies in the science of our own brains, and it comes from the pioneers of behavioral economics.
So, two absolute legends in psychology, Daniel Kahneman and Amos Tversky, ran these brilliant experiments that uncovered this really fundamental and frankly kind of bizarre quirk in how we all think about risk.
So imagine I offered you a choice. You can have a guaranteed $3,000 right now, or you can take an 80% chance at winning $4,000. Now, if you do the math, the gamble is actually the better bet on average. It's worth $3,200. But what did almost everyone do? They took the sure thing. When we're talking about gains, we are deeply risk-averse. We want that comfortable, guaranteed win.
But then they flipped the script. Now, the choice is between a sure loss of $3,000
or an 80% chance of losing 4,000. It is the exact same math, just framed as a loss. And here, people's behavior did a complete 180. The vast majority suddenly chose to gamble on the bigger potential loss just to avoid the pain of a sure, smaller one. When faced with a loss, we suddenly become huge risk takers.
And that, right there, is the core of what they call prospect theory. And it explains everything we've been talking about. It's why we do those destructive things. We're scared of risk when we have a profit, so we grab our small winnings off the table way too early because it feels safe. But we become total gamblers when we have a loss. We'll hold on to a losing position forever, praying it comes back just to avoid the certain pain of admitting we were wrong.
So right about now, you're probably thinking, okay, fine, I get it. Humans are a mess. I'll just use a computer. A system with rules will save me from myself. Well, you'd think so, but unfortunately, our human need for comfort finds a way to screw that up too.
Here's the trap so many people fall into. A trader builds a system, and they run a back test to see how it would have done in the past. They see that, yeah, I would have made money, but wow, there were some really scary drops along the way. That volatility feels uncomfortable. So they start adding new rules to fix those past bumps. They tweak and they tweak until the historical performance chart looks like a beautiful, smooth line going straight up. It looks perfect. It feels safe.
But here is the devastating irony. In the process of making the system look comfortable and perfect for the past, they've made it brittle and fragile for the future. They've fine-tuned it for a history that is never, ever going to repeat itself in exactly the same way. The very act of seeking emotional comfort by designing a perfect system is what all but guarantees its failure going forward.
Okay, so let's bring this all home. We've looked at the theory, the real-world data, the deep psychology. What's the one big lesson we need to take away from all of this? The legendary trader Richard Dennis, who is actually Eckhart's partner, put it about as bluntly as you possibly can. Now, this quote sounds a little extreme, I know, but it's such a powerful mental check. If a financial decision feels easy, if it feels comfortable, if it feels emotionally satisfying, that should be a giant red flag, a warning sign to just pause and think again.
And that's really the ultimate point here. For most of us, the biggest thing holding us back from financial success isn't a lack of knowledge or a bad strategy. It's our own deep-seated, very human need for comfort. A need that pushes us to make choices that aren't just random, but are actively self-destructive.
But look, here's the good news. You don't have to become a robot to fix this. The first and most powerful thing you can do is to just be aware of this bias. Simply knowing that your brain is going to try to trick you into choosing what's comfortable is half the battle. That awareness is what gives you the power to stop and ask yourself, does this feel good because it's the easy thing to do or because it's the right thing to do?
And really, that's the final question I want to leave you with. Because this isn't just about money, is it? Think about your career, your relationships, your health. What comfortable decision, what easy path is keeping you from where you actually want to be? It's definitely something to think about.
Okay, so when you picture high-stakes trading, what do you see? I bet it's something straight out of a movie, right? Screens flashing everywhere, phones ringing off the hook, people yelling, all of it just fueled by pure adrenaline. But what if I told you that for the world's absolute best performers, that feeling, that adrenaline rush, is actually a sign that they've failed? It's a fascinating, kind of counterintuitive idea, so let's dive right in.
All right, so for this, we're pulling our insights straight from Chapter 17, which is all about emotions and trading. This chapter really unpacks the psychological traps that even the smartest people fall into. And the whole thing starts, interestingly enough, not on a trading floor, but on the face of a 2,000-foot cliff.
So check out this quote. It's from Alex Honnold, the guy who climbed the insane vertical wall of Half Dome with no ropes. When someone asked him about the adrenaline rush, this is what he said. He thought the whole experience should be slow and controlled. That single idea, that's the absolute key to understanding the psychology of elite trading. It's wild.
Yeah, you heard that right. That feeling of a racing heart, that surge of adrenaline, it's not a sign that you're in the zone. Nope. For the real experts, it's more like a blaring alarm, a giant red flag that they've lost control and something has gone horribly wrong. And believe it or not, this exact same mindset applies just as much to a trader managing millions of dollars as it does to a climber literally clinging to a rock face.
So the big question is, how do we get a handle on our emotions in these super high-stakes situations? Well, we're going to walk through 5 key lessons here. First up, we'll see why control is way more powerful than adrenaline.
Then we'll look at the steep price of chasing excitement. After that, we'll talk about the poison of making a desperate bet and the absolute destruction that comes from impulse. And finally, we're going to tackle the trickiest question of all: how in the world do you tell the difference between a bad impulse and a genuinely valuable intuition?
All right, so first stop, this core idea. Mastery is all about control, not chaos. The best of the best, doesn't matter if it's in sports or finance, they aren't just riding some wave of emotion. No, they are executing a deliberate, super-controlled plan. And emotion is the #1 enemy of that plan.
And that brings us right to the first major trading sin, treating the market like it's your personal casino. I mean, if you're looking for a thrill ride, you're going to find one. But you're also going to pay a very, very high price for admission. And this story from the legendary trader Larry Hite, man, it shows us exactly why. You know, the context behind this quote is everything. Larry Hite actually said this to a friend of his who had just gone completely broke. And the friend just couldn't wrap his head around how Hite could stand following this boring, computerized system. Hite's reply just cuts right to the heart of it all. The goal isn't to feel something, the goal is to win.
And this next story just illustrates the point perfectly. Coach Charles Faulkner tells this story about a client he had. This guy had a winning system, a proven one, but he was just too emotional to follow it. So Faulkner coached him, taught him to be detached. And guess what? It worked. The client started making money. But then, after one really profitable day, he just turns to Faulkner and says, flat out, "This is boring." You can probably guess what happened next. He quit the system, went right back to chasing that thrill, and poof, blew up his account. He was addicted to the excitement, not to actually winning.
Okay, so next up, we're diving into an even more dangerous emotion: desperation. This is that feeling when you just have to win, like right now. That kind of neediness, it just completely clouds your judgment. It forces you into these incredibly reckless situations, something a young trader named Stanley Druckenmiller learned in just about the most painful way possible.
So picture this. It's 1982. Stanley Druckenmiller's young farm is literally on the brink of collapse. They've just lost a key contract, and this number you see, $50,000, that's it. That's every last bit of capital the company has left. I mean, his back was completely against the wall.
Now, he was absolutely convinced that interest rates were about to fall. So in this desperate Hail Mary pass to try and save his firm, he takes that entire 50 grand and plows it all into one single, highly leveraged trade. We're talking everything on the line. He was all in. And this is the truly tragic part. Just 4 days later, interest rates tick up, and he's completely wiped out, gone. The crazy irony, just 1 week after that, the market totally reverses and rates start a massive decline. His analysis was perfect. He was 100% right about where the market was headed, but the emotionalism of the trade, that desperation, the insane leverage, it just doomed the whole thing from the very start.
Which leads us right into our next emotional trap: impulse. You know what I'm talking about? Those unplanned, spur-of-the-moment decisions that can just completely undo months, sometimes even years of hard work, all in what you might call a single moment of insanity.
The story of Bruce Kovner's most painful trade is such a classic example of this. And what makes it so powerful is that it all starts with him being absolutely spectacularly right in his analysis of the soybean market. He had set up this really brilliant trade to profit from a shortage.
So his profits are just soaring. Everything's going great. Then, one morning, his broker calls him up, completely breathless with excitement, basically yelling this into the phone. He's telling Kovner to just abandon part of his strategy so he can make even more money, even faster.
And Kovner, he gets totally swept up in the mania of the moment. He just abandons his carefully constructed risk management. He agrees to get rid of the protective side of his trade, which basically left him completely exposed. He was betting everything on the market just continuing to scream upwards.
Looking back on it, this is how Kovner himself described that decision. He said, he just lost the process of rationality he thought he had. It was a complete and total breakdown of discipline, all triggered by the emotion of that one moment.
And here is the gut punch. Just 15 minutes after that first euphoric phone call, the broker calls back. But this time, he's frantic. The market had just violently reversed. It was limit down, which means prices were falling so fast they literally had to halt trading. So get this. The crucial point is that in the span of time between those two phone calls, that one single impulsive decision had cut his entire account equity in half. A 50% loss in a single day. All because of one unplanned, emotional trade. And listen, Kovner's story is not some one-off thing. You've got Michael Marcus, who impulsively cashed out of a massive winning trade, only to watch in agony as the market just kept going up for 12 straight days without him. You have Marty Schwartz, who warns that the impulse to immediately try and make back a loss is a recipe for failure. The bottom line is crystal clear. Trades that are born from raw emotion and impulse are, without a doubt, the most dangerous trades you can possibly make. Okay, so this all leads us to the final, and maybe the most important question of all. If impulse is so terrible, then what about intuition? What about that gut feeling? How can you possibly tell the difference between a disastrous impulse and a truly brilliant insight? First things first, let's just define what we're talking about. Intuition isn't some kind of magic or mystical force. The source here defines it simply as subconscious experience. It's basically your brain recognizing a pattern that it's seen before, from the thousands and thousands of hours you've spent studying something. But it's all happening below the level of conscious thought, and, this is the crucial part, it's happening without the distortion of emotion.
And what's so helpful here is seeing them side by side. An impulse is all emotional and reactive, whereas intuition is objective and reflective. An impulse is totally unplanned. It comes out of nowhere. But intuition? That's built on a deep foundation of experience. Impulse just ignores risk. It's driven by pure hope or fear. But intuition always acknowledges risk because it's based on recognizing real patterns you've seen before.
And so that leaves us with this one final crucial question that comes from one of the traders in the book. The ultimate challenge, really, is being able to separate what you want to happen from what your actual analysis tells you will happen. So you have to ask yourself, are you acting out of pure hope, or are you acting based on real experience and probability? Answering that one question honestly, well, that's what separates an amateur's disastrous impulse from an expert's winning intuition. All right, let's get right into it. We're going to be talking about a really critical concept for any trader. And that's the difference between a static, rigid strategy and a dynamic, flexible one. Honestly, understanding this distinction can be the thing that separates long-term success from just, well, a lot of frustration. So let's kick things off with a problem that I'm willing to bet hits close to home for a lot of you. You find a strategy, right? It's got clear rules, it's working beautifully, and you feel like you've finally cracked the code. And then, poof, it just stops working. The wins dry up, the losses pile on, and you're left scratching your head wondering what on earth happened. Well, that right there, that's the static trap. So here's what we're going to cover in this explainer. We'll dig into exactly why winning strategies fail. We'll look at the art of adaptation. We'll cover smarter ways to get in and out of trades, and then we're going to get into a really advanced technique called trading around a position. It's all about understanding what gives the dynamic trader their edge.
All right, so why? Why do these rock-solid systems just crumble? Why does a strategy that was printing money suddenly start to bleed it? It really all boils down to one single fundamental truth about how markets actually work.
Macro manager Colm O'Shea just nails it with this quote. See, the market isn't some static machine that you can just figure out once. No, it's a living, evolving ecosystem. It's constantly changing. Think about it. New tech, new rules, shifts in what everyone is thinking, it all changes the game. And if you're stuck rigidly playing by old rules in a new game, you're going to lose. It's like you're fighting yesterday's war.
Okay, so theory is one thing, right? But let's see how this plays out in the real world with a true master of adaptation, the legendary quant trader Edward Thorp. This guy didn't just have one good idea. His genius was in his ability to constantly evolve.
So Thorpe was a pioneer of this thing called statistical arbitrage. It sounds super complicated, but the core idea is actually pretty genius. You use math and data to find stocks that are, for a short time, mispriced compared to each other. You buy the cheap ones, you short the expensive ones, and you wait for things to snap back to normal. The beauty of it is that you're trying to stay protected from those huge, unpredictable market swings.
So his first huge win was a strategy he nicknamed MUD, which stood for most up, most down. The system found that stocks that had fallen the most tended to bounce back pretty strongly, and vice versa. And for years, it worked like a charm. But you know how this story goes. Nothing lasts forever. As more traders and faster computers caught on to similar ideas, that profitable edge he had started to get thinner and thinner, until eventually it just evaporated. So here's the crucial part. What did Thorpe do? Did he throw in the towel? Nope. He adapted. He leveled up. He made the strategy more sophisticated. At first, it was just market neutral. When that edge started to fade, he evolved it to be sector neutral, so he wasn't making some accidental huge bet on, say, the entire tech industry. And when even that wasn't enough, he evolved it again to be neutral to even more complex mathematical factors. That is what macro adaptation looks like.
Okay, so that's the big picture stuff, adapting your whole system over years. But being dynamic isn't just about that. Let's zoom way in, down to the level of managing a single trade.
Oh man, this is a classic, right? Every trader has felt this exact anxiety. You love a stock, you think it's going higher, but it's just had this massive run. So what do? Do you chase it and risk buying the absolute top right before a nasty correction? Or do you wait patiently for a pullback and risk it just taking off without you? It feels like this terrible all or nothing choice, but it doesn't have to be.
The dynamic way to handle this is to scale in. So instead of throwing all your cash in at one price, you just buy a piece of your position now. If the market keeps running, hey, great, you're on board. But if it pulls back, you can add more at a cheaper price, which lowers your average cost. It totally changes the game by removing that paralysis of having to be perfectly right now.
And this isn't just for getting into a trade. The same powerful logic works for getting out. The legendary currency trader Bill Lipschitz talks about this all the time. By selling a part of a winning trade, he locks in some profit. That makes it so much easier psychologically to just relax and hold on to the rest of the position to try and catch a really big long-term move.
Look, here's the bottom line with scaling. You are consciously giving up on the fantasy of buying the absolute low tick and selling the absolute high tick. It's not gonna happen. But in exchange, you're protecting yourself from the absolute nightmare of buying the top or selling the bottom. You're trading perfection for resilience.
All right, buckle up. We're now moving into our final and most advanced concept. This is a dynamic approach that is so powerful it can actually let a trader make money even when they're totally wrong about where the market is headed.
Just think about that for a second. It sounds completely impossible, doesn't it? I mean, if you short a stock and the stock goes up, you lose money. End of story. Well, maybe not. This is a technique that separates the truly elite traders, guys like Jimmy Belodemus, from pretty much everyone else.
This guy, Jimmy Belodemus, is famous for doing everything they tell you not to do in the trading books. He sells when things are screaming higher. He buys when there's panic in the streets. He'll even add to a losing position. I mean, on the surface, it sounds like he's just gambling, right? But believe me, there is a deep, profound method to what seems like madness.
And this quote right here, this is the key to the whole kingdom. His secret isn't just what he trades, it's how he manages his position size. He is constantly, actively adjusting how much he has on based on what the market is doing second by second. He doesn't just put a trade on and wait.
Let's walk through this because it's really cool when you see it in action. Let's say he's short a stock. He puts on his core position. Now, if the market drops a little bit and he's got a small profit, he'll buy some shares back to lock that profit in. Then, when the market does what it does and rallies back against him, he uses that as an opportunity to re-short the shares he just covered, but now at a higher, better price.
And the results of this method? They're just incredible. Every one of those little cycles, selling high, buying back low, puts cash in his pocket. And if he does that enough times, he can literally make money, even if the stock ends up way higher than where he started shorting it. He turns volatility, the thing most people are terrified of, into his main source of profit. It's brilliant.
So let's tie all of this together now. We've talked about big picture adaptation like Ed Thorpe, we've talked about scaling in and out of trades, and this really active method of trading around a core position like Jimmy Belodemus. So what's the common thread? What's the real edge that separates the static trader from the dynamic one?
When you boil it all down, it really just comes back to one thing: mindset. The static trader has a fixed set of rules, and they need the market to obey those rules to make money. The dynamic trader, they're flexible. They're constantly adjusting what they're doing based on what the market is giving them. One is a set-it-and-forget-it approach. The other is about constant engagement.
And maybe this is the most important thing to remember from this whole discussion. The static trader is making a bet on being right. Their whole trade depends on their forecast being correct. The dynamic trader, on the other hand, is building a process that's resilient, a process that can handle being wrong about the timing or even the direction and still find a way to come out ahead.
So that leaves us all with a pretty important question to ask ourselves. Is your approach to the markets built to last? Or is it built for a market that maybe doesn't even exist anymore?
Have you built a flexible, adaptive process that's ready for whatever comes next, or are you just waiting for the world to move on without you? Thank you for joining me for this explainer. Making that shift in your mind from being static to being dynamic is one of the most powerful changes a trader can make. I really hope this deep dive gave you some valuable new ideas to think about, and maybe even apply to your own process.
Welcome to the Explainer. Today, we're going to decode the secret language of the world's best traders. And here's the secret. It's not about the news, it's about how the market reacts to the news. This one little shift in thinking can totally change how you see everything. It reveals what the market is really thinking. So let's just jump right in with this absolute gem from the legendary trader Marty Schwartz. Think about that for a second. It flips all the conventional wisdom completely on its head, right? He's saying that you find out if a market is truly strong or weak, not by looking at the events themselves, but by watching the response to them. So here's our game plan for today. First, we're going to unpack this whole counterintuitive idea. Then, we'll dive into some incredible real-world stories from some master traders. After that, we'll get into the why. Why does the market act this way? And finally, we'll boil it all down into a core strategy you can use to read the market's true tone. Okay, so here's the absolute crucial point, the main takeaway if you remember nothing else. The actual news, whether it's an economic report, a war, a big policy change, that's all secondary. The thing that really matters, the thing that holds the real information, is how the price reacts. That reaction, that's the ultimate truth teller. Theory is one thing, but let's see how this actually plays out in the wild. We're going to dig into some classic stories where the markets did the exact opposite of what everyone, and I mean everyone, including the smartest people in the room, fully expected to happen. So our first case study comes from a trader named Randy McKay, and it's during the first Gulf War back in 1991. Now, every textbook on the planet will tell you that war is bullish for gold. It should drive the price way up as investors run to safety. But Randy McKay, he wasn't watching the textbook. He was watching the tape. Let's just walk through this timeline. So on the night before the war starts, gold is trading just under $400 an ounce. The attack begins, and just like everyone expected, it spikes up to 410. No surprise there. But then, the surprise. The rally just completely fizzles out. Gold doesn't just stop going up, it falls all the way back to 390. That's lower than where it started. And then it just keeps on falling for months. Now for Randy McKay, this was a massive, flashing red signal. Think about it. If the ultimate bullish news for gold, a major war in the Middle East, can't even get the price to stay up, what does that tell you? It told him the market was fundamentally, deeply weak. He read that failure to rally as a huge sign of weakness, and boy, was he right. All right, now for another legend, Ray Dalio, the founder of the massive hedge fund Bridgewater Associates. Early in his career, he got absolutely blindsided, not once but twice, by the market's totally bizarre reaction to what seemed like world-ending news. Okay, just look at these two events. First, in 1971, President Nixon just rips up the rulebook and takes the U.S. off the gold standard. Dalio was sure it was going to be a disaster for stocks. But what happened? The market rallied, and it rallied hard. Then you fast forward to 1982. The U.S. is in a nasty recession, and Mexico defaults on its debt, putting major American banks at risk. Catastrophe, right? Nope. That very day marked the exact bottom of the bear market and kicked off a monster 18-year bull run. Just incredible. So this brings us to the big question, doesn't it? Why does this happen? Is the market just completely irrational? Well, not exactly. There's actually a logic to this madness, and it really comes down to two key things. First off, markets are brilliant at looking ahead. So by the time a big event that everyone's been talking about, like that Mexican default, actually happens, it's often already priced in. Everyone who was going to sell has already sold. But the second reason, and this one is even more powerful, is that markets don't just anticipate the crises. They anticipate the response to the crises. They know that really bad news forces the hand of central banks to step in and open the floodgates. And this is the huge lesson Ray Dalio learned. The medicine, the central banks coming to the rescue with tons of stimulus, can be so much more powerful for asset prices than the disease of the initial crisis was bad. The market stops reacting to the bad news and starts reacting to the coming rescue package. All right, so let's shift gears now. Let's look at how the absolute masters of this game use this understanding not just to avoid getting steamrolled, but to actually find their biggest and best opportunities. It's all about learning to read the market's tone. This next story is just fantastic. It's about another legend, Stanley Druckenmiller. So he was holding this massive position, betting that the German currency, the Deutschmark, was going to go up against the US dollar. And then some news broke that should have absolutely crushed him. Okay, just follow this chain of events. So Druckenmiller is betting big against the US dollar. Then news hits that the Iraq war might end early. Now that should have been terrible news for the dollar, which was being held up as a safe haven. The dollar should have just fallen off a cliff, but it didn't. It barely even budged. Druckenmiller said he smelled a rat. That strength, that resilience was a huge tell. It told him the dollar was way stronger than anyone thought. And so on the spot, he completely flipped his view and sold his entire $3.5 billion position. And here's another angle on that same idea, this time from trader Michael Platt. He's got a big trade on, and then a whole string of bad news comes out, news that he knew should have really hurt his position. Each time a new headline hit, he was bracing himself to get screwed, as he put it. But his position was completely fine. It was like it was invincible. He realized this was a massive sign of underlying strength. So what did he do? He didn't just hold on, he quadrupled his position, and it turned into his biggest winning trade of the entire year. So when you take all these incredible stories from McKay, Dalio, Druckenmiller, and Platt, you can really boil them all down into one single, powerful, and actionable trading principle. A trader named Scott Ramsey gives this brilliant analogy that I just love. He says to picture a healthy market that gets hit with some bad news. That news is like a hand pushing a volleyball underwater. Now, if the market were weak, it would just sink. But a strong market, it fights back. Its resilience, its refusals to stay down, that's the sign that it's just coiled with energy, ready to explode upwards the second that hand lets go. And this perfectly illustrates the huge difference between how novices and pros look at the market. You know, the novice is always looking for what's cheap, the thing that hasn't moved yet, hoping to find a bargain. The pro? The pro is looking for what's strong, the market that's proving its strength by literally shrugging off bad news. They're betting on momentum, not just value. And of course, this principle works perfectly in the other direction too. Michael Marcus nails the other side of this coin. When a market gets fantastic news and it still can't rally, it's sending an equally powerful signal. It's basically screaming that it's exhausted and ready to roll over. Marcus saw this happen in real time. It was during a massive commodity bull market where everything was just soaring. Cotton gets this ridiculously bullish report, and everyone expected it to launch. But instead, it just sputtered. It couldn't go up. That failure to perform was the ultimate sell signal. And get this, that day marked the exact top of the cotton market, a high that wasn't seen again for over 30 years. This all brings us to the ultimate question that Michael Marcus says you have to ask yourself in these moments. If the good news is already out and everyone who was ever going to buy based on that news has already bought, then who is left to push the price any higher? When a market can't rally on good news, the answer is often nobody. The buyers are all tapped out. So the next time a huge headline breaks and you see everyone around you either panicking or celebrating, just take a step back. Remember what we've talked about here. The real story isn't in the headline itself. The real signal is in the market's response. So ask yourself, are you going to watch the news or are you going to watch the reaction? You know, from the time we're kids, we're basically taught to avoid mistakes at all costs, right? To fear them. But what if that's completely backward? Today, we're going to dig into this really powerful idea that embracing our errors, actually leaning into them, is the fastest way to get better at pretty much anything. So let's start with this. Just let it sink in for a second. What if every single wrong turn you've made, every project that failed wasn't a setback at all? What if it was actually a hidden treasure map, pointing you toward a much, much better way of doing things? It's a huge shift in perspective, I know, but it's a way of thinking that's backed by some of the most successful people in history. I mean, just look at James Dyson. He didn't see over 5,000 failures. He saw over 5,000 discoveries. Every single one of those prototypes that didn't work taught him something crucial. It was a vital piece of the puzzle. That's not failing. That's just research. It's how you innovate. And of course, there's the classic from Thomas Edison. Now, this isn't just some clever thing to say. It is a fundamental change in how you define progress. Every single way that won't work is another data point.
It's another path you can cross off the list, which by definition moves you closer to the one that will work. It's all a process of discovery, not a series of defeats. And this quote kind of brings it all home, doesn't it? Think about it. Success. Well, success usually just confirms what you already know. It can make you comfortable, maybe even a little lazy. But an error? Oh, an error forces you to stop dead in your tracks. It makes you think, analyze, and actually learn something new. It is the real engine of growth. And that's the big idea we're going to unpack today. So how do we make this shift in our own heads? Well, we start by completely reframing what a mistake even is. We learn to see it not as this ugly failure, but as something genuinely useful, something you could even call a beautiful mistake. And our guide on this journey is the legendary investor Ray Dalio. For him, this isn't just a nice idea. He truly believes that mistakes aren't just part of the process, they are the process. They're the primary engine that drives all improvement. Dalio actually wrote this whole philosophy down in a book called Principles. And get this, it's required reading for every single person who works at his hugely successful company, Bridgewater. So this isn't just a feel-good mantra, it's the literal operating manual for one of the most successful hedge funds on the planet. Now listen to the words he uses here. It's so important. A puzzle and a gem. He takes this painful experience of being wrong and turns it into an exciting challenge. That sting you feel when you mess up, that's actually a signal. It's telling you there's a valuable lesson right there waiting to be found. The biggest thing that gets in our way, honestly, is our own ego. Our ego wants to be right all the time, and it makes failure feel like a personal attack. But if you can just push past that feeling and solve the puzzle, you get the gem, a brand new principle that helps you avoid making that same exact mistake ever again. Okay, so let's see how this plays out on a bigger scale. How does a personal philosophy like this become the foundation for an entire company culture? Because it's one thing to change your own mind, but it's another thing entirely to build an environment where this kind of radical learning can actually happen. This is literally how they do it. This is how Dalio wires it into his company's DNA. And notice the really important distinction here. It is totally okay to fail. It's expected. What's unacceptable is to not identify that failure, to not analyze it, to not learn from it. The whole system is designed to reward reflection, not perfection. It just accepts the basic reality that we all have weaknesses, and it shifts the focus from pretending we don't have them to figuring out how to deal with them. And this just illustrates the point perfectly. The trader Marty Schwartz points out that in most jobs, we can kind of get away with covering up our mistakes, right? We can blame someone else or just hope nobody notices. But in a field like trading, there's nowhere to hide. The results are right there in black and white or, bright red. The numbers don't lie. And it's that forced confrontation with reality that makes you learn so incredibly fast. Okay, so we've got the philosophy. We've seen how it works in a high-performance culture, but how do we actually apply this ourselves, like day-to-day in a systematic way? Well, let's break it down into a practical, repeatable process we can call the learning loop. You see, the secret ingredient here is analysis. The trader Randy McKay didn't just make trades and then cross his fingers. No, he built a rigorous, disciplined routine of reviewing absolutely everything. Why did I win on that one? Why did I lose on this one? This habit of systematic review is what separates the pros from the amateurs. And it all really boils down to this simple 5-step loop. First, you just do something. You execute. But then comes the critical part. Step 2. You have to write down why you're doing it and what you expect to happen. You have to record your thinking. Then, step 3, you review what actually happened and compare it to what you expected. That gap, the space between what you thought would happen and what did happen, that is where the lesson is hiding. You analyze that gap to find the gem, and then, finally, you adapt. You decide what you're going to do differently next time. And at the end of the day, that whole 5-step loop is designed to help you follow this incredibly simple but powerful piece of advice from Steve Clark. The analysis isn't just for fun. It's meant to give you a clear action plan. Figure out what's working so you can do more of it, and figure out what isn't so you can stop. Simple as that. And it is so important to get this. This loop is not just for Wall Street traders. You can apply this to literally anything in your life. That project at work that went sideways, that tough conversation you had, that new hobby you're trying to learn, record your plan, review the result, find the lesson, and adapt. It is a universal tool for getting better at anything. So here we are. We've gone from being afraid of mistakes to seeing them as puzzles. We've gone from hiding failure to building systems that demand we learn from it. We've basically turned the whole idea of failure completely on its head. Because here's the honest truth. You are going to make another mistake.
probably sooner than you think. It's not a maybe, it's a certainty. So the real question isn't if you'll fail again. The question is, what are you going to learn from it? The next time you feel that sting of getting something wrong, I want you to remember the puzzle and the gem. Your greatest chance to grow is right there, waiting for you to solve it.
All right, let's dive in. Today we're talking about a concept that, honestly, separates the real strategic thinkers from everyone else. It's this crucial difference between having a great idea and having a great implementation. And trust me, that distinction, it can mean absolutely everything, and we're about to find out why.
So, let me ask you something. Have you ever been in that spot, that super frustrating place where you were intellectually right about something big? You totally called it. You knew what was going to happen, but when it all went down, you were just kind of left on the sidelines, or even worse, you actually lost out. It's a really common and painful experience, and it's exactly what we're going to tackle today.
And this right here, this is the core of our entire explainer. The genius isn't always in just seeing what's coming. A lot of the time, it's about picking the smartest, safest, or most leveraged path to get there. The what is of course important, but the how, well, the how can be the whole ballgame.
So here's our game plan. First, we're going to define what we mean by the implementation principle. Then we'll see it in action with two really fascinating case studies. One is all about defense, the other is all about offense. After that, we'll pull out the key lessons from those stories, and finally, we'll talk about how you can actually use this way of thinking for yourself.
Okay, let's get into it. Section 1, the implementation principle. Before we jump into the stories, we really need to get our heads around this core strategic idea. It's the foundation for everything else we're going to talk about.
This quote from our source material just says it all, doesn't it? It is not enough to just be right. You have to be right in the right way. The method you choose, the vehicle you use, how you execute, that's where the real magic happens. So to see what this actually looks like in the wild, let's jump into our first case study.
All right, let's put this principle to the test. Our first case study takes us back to the late 90s. We're going to look at how one investor, Cole Moshe, navigated one of the craziest market manias in modern history, the dot-com bubble.
So, try to picture it. The year is 1999. Irrational exuberance is just everywhere. Companies that have never made a dime are suddenly worth billions of dollars. I mean, everybody can see it's a bubble, and Cole Moshe is totally convinced a huge crash is right around the corner. The idea seems pretty simple, right? Just bet against the market.
So this is where it gets really interesting. You see the dilemma here. The obvious idea, the one everyone thinks of, is to short the index. Basically, you're placing a bet that it's going to go down. But O'Shea knew something that most people just completely overlooked. The path down is never a straight line. No, it's a violent, chaotic, stomach-churning ride, and it's filled with these massive, sharp rallies that can totally wipe you out, even if you're ultimately right. And this number just perfectly illustrates that danger. After the bubble finally popped in March of 2000, the Nasdaq staged this monster 40% rally over the summer. Think about that. Anyone who had shorted the market was right about the crash, but they would have lost everything, forced to abandon their bet during this insane rebound. So the obvious implementation? It was actually a death trap.
So instead of taking that direct, really dangerous path, O'Shea used what you might call second-order thinking. He thought it through. Okay, when the bubble bursts, step 1, that's going to hurt the U.S. economy. Step 2, and when the economy slows down, the central bank is going to cut interest rates to try and fix it. Step 3. And then, when interest rates fall, the price of existing government bonds goes up. Bingo! He found an indirect and much, much safer way to play the same exact idea.
And here's the beautiful result of that thinking. Path A, shorting stocks, was an absolute heart attack-inducing roller coaster. Path B, buying bonds, was a nice, calm, steady climb. He was right on the big idea. A major downturn was coming, but his true genius was in choosing an implementation that just filtered out all that terrifying volatility.
As you can imagine, O'Shea's trade was a massive success. And it wasn't just because he was right, it was because of how he did it. He proved that the path you choose is every bit as important as the destination you're trying to reach.
Okay, so that was defense. Now let's flip the script and talk about offense. Our second case study features another investor, Joel Greenblatt, who used this same principle, not to avoid risk, but to dramatically juice his potential rewards.
So the scene now shifts to the early 90s. California's in a massive real estate recession, and Wells Fargo Bank, which has a ton of exposure, is just getting crushed. The market is basically terrified the bank could go under, and the stock price reflects that fear. having plunged all the way down to about $80. But Greenblatt, he thinks the bank is going to survive and that the stock is a bargain.
So, what's the simple idea? Well, you just buy the stock, right? If he's wrong and the bank goes bust, he loses his 80 bucks. If he's right and the stock doubles, he makes 80 bucks. It's a very straightforward one-to-one risk-reward. It's good, but it's not great. Greenblatt started wondering, is there a better way to do this?
And this right here is his light bulb moment. Instead of buying the stock itself, he looked into buying something called leaps, which are just a fancy name for long-term options. See, an option gives you the right to buy a stock at a certain price, but you don't have to. And because they cost way, way less than the stock itself, using this different tool could totally change the math of the entire bet.
And just look at this. It shows you the incredible power of implementation. By buying the options instead of the stock, if the stock doubled, he would make 5 times his money, not just double it. His risk was still perfectly defined. He could only lose the small amount he paid for the options, but his potential reward just went through the roof. He took the same core idea, that Wells Fargo is going to be fine, and found an implementation that gave him this incredible, skewed payoff.
So we've got these two amazing stories. One is about playing incredible defense, the other is about playing incredible offense. Let's try to boil them down into 2 concrete strategic tools that you can actually use.
So the first lesson, this comes straight from Comoshe. We're going to call it volatility filtering. It's really the art of finding an indirect path to your goal, one that avoids all the major potholes and traps along the way. It's all about asking yourself, is there a calmer sea I can sail to get to the exact same shore?
And the second lesson, this is from Joel Greenblatt, we'll call risk/reward optimization. This is all about actively looking for different ways to implement an idea that completely warp the payoff in your favor. It's about turning a 50-50 bet into one where, heads you win huge and tails you only lose a little.
So now we have these 2 really powerful strategies, filtering out the bad stuff and optimizing for the good stuff. But how do we make this practical? So in our final section, let's look at how you can apply this implementation mindset to your own decisions.
Here it is, your takeaway checklist. The next time you have a big idea, whatever it is, don't just stop there. Push yourself to go one step further. Ask, what is the absolute best way to execute this? Really analyze the journey, not just the destination. Look for that smoother path like O'Shea did, or look for that supercharged reward structure like Greenblatt found. And I'll just leave you with this question to think about. Because that gap, the gap between a dream and reality, between being right in theory and being successful in practice, it so often comes down to one single thing: the brilliance of your implementation. All right, let's jump right in. Today, we're going to unpack a piece of trading wisdom from a true market legend. And here's the thing. It is so incredibly counterintuitive that it goes against pretty much every natural instinct you have when things go wrong.
You know the feeling, right? You're in a trade, the market is just screaming against you, and that knot in your stomach tightens. Panic starts to creep in. All you want in that moment is a magic button, some easy way out to just stop the bleeding. It's a feeling that anyone who has ever put capital on the line knows all too well.
But what if that exact moment, that glimmer of hope, that chance to escape, is actually a signal you should ignore? Well, according to market wizard Marty Schwartz, that's exactly what it is. His big idea is this: when the market gives you a total gift, an unbelievably easy exit from a trade you were absolutely terrified about, you should actually hold on. I know, it sounds completely backward, doesn't it?
So let's really dig into this. What we're talking about here is a really unique observation that challenges our most basic response to risk, fight or flight. When the market throws you a lifeline, our gut instinct is to grab it and get out. Schwartz's rule says that's probably the worst thing you could do.
Look, a lot of trading advice is pretty standard stuff, right? Manage your risk, be disciplined, it's all crucial, but it's also common sense. But every once in a while, an idea comes along that just goes completely against the grain. This rule? This is one of those rare gems. To really understand how powerful this is, nothing beats seeing it in action. So let's dive into a high-stakes, real-world story about Bill Lipschitz, a legendary trader who found himself in one of the scariest positions of his entire career. Okay, so the scene is the fall of 1988. Bill Lipschitz, who's a huge name in foreign exchange at the powerhouse firm Salomon Brothers, decides to make a massive bet. He's taking a short position, betting that the US dollar is about to fall against the German Deutschmark. And when I say massive, I mean a jaw-dropping $3 billion. Now, why so big? Well, the market was really quiet, just kind of sleepy with low volatility. And that calm kind of lulled him into taking on way more size than he normally would. So the stage was set for either a huge win or an absolute catastrophe.
And then boom, disaster. It's a Friday afternoon, and out of nowhere, Mikhail Gorbachev gives a speech at the UN. He announces Soviet troop reductions. Now the market instantly takes this as a huge positive for the US deficit, which means it's good for the dollar. And just like that, the dollar starts ripping higher, moving directly and violently against Lipshitz's monster position. He is now in a trader's absolute worst nightmare. He wanted to get out right then, liquidate everything, but he couldn't. It was late on a Friday and the market was incredibly thin. There was just no way to unload a $3 billion position. He was completely, utterly trapped until the Tokyo markets open again on Sunday night. In a last-ditch, desperate move, he tries to fight the market. He sells another $300 million to try and force the dollar back down. But the market, it doesn't even flinch. It just absorbs that massive order like a sponge. And that's the moment he knew he was in really, really deep trouble.
He literally has to walk over to the president of Salomon Brothers and say those 5 chilling words, "We have a problem." He lays it all out. He's short, he can't get out, and he can't buy the position back. The bleeding just won't stop.
So the president asks him, where are we? And Lipschitz has to deliver the gut punch. The firm is down somewhere between $70 and $90 million. His only plan is to wait for Tokyo to open and just hope he can dump half the position then. It was going to be a very, very long weekend.
So, Sunday night finally rolls around. After 2 solid days of just pure stress, Lipschitz is glued to his screen as the Tokyo market opens. And then, something absolutely incredible happens. The dollar, it's actually moving lower. The market is moving in his favor. He was being let off the hook.
So what do you do in that situation? The whole plan was to cut your losses, to run for the exit, and now you've got this miracle opportunity to get out at a way better price than you ever thought possible. Every single fiber of your being is screaming, sell, get out now, right?
But Lipschitz does the exact opposite. He completely throws his plan out the window. Instead of scrambling for that exit, he just waits, and the dollar keeps sliding, moving more and more in his favor.
He ends up covering the entire position later in the European session. The final damage? An $18 million loss. Now, don't get me wrong, that is a huge number. But when you compare it to the $90 million disaster he was staring at just 2 days earlier, it felt like a massive win. He knew that taking the easy way out would have been the wrong move.
Now, that's a pretty dramatic story from a market titan. But this rule isn't just for billion-dollar traders. Here's another quick story, a more personal one, where a trader was saved by remembering this exact piece of advice from Marty Schwartz.
So, back in 2011, the author of our source material here was heavily short the NASDAQ. A really bad unemployment report comes out, news everyone agreed was terrible. The market sells off hard, but then, unbelievably, it rallies all the way back and closes the week strong near multi-year highs. By any objective measure, he was completely on the wrong side of this trade.
He basically spent the weekend just accepting that he was about to take a massive loss. But when the market opened Sunday night, he was stunned. Instead of ripping higher, it was down 15 points. He had been let off the hook. And in that moment, Schwartz's rule flashed in his mind. Instead of dumping his entire position with a sigh of relief, he sold only a tiny piece. And sure enough, the market kept plummeting, saving him a fortune.
Okay, so we've heard 2 pretty incredible stories where this rule worked perfectly. But the really big question is, why? Why on earth does this weird, counterintuitive advice actually work? Let's break down the psychology.
Yeah, this isn't some kind of magic trick. There's a really powerful logic at play here. A very good reason you shouldn't just grab that easy exit. This visual here lays it out perfectly. So first, some big news event happens, something that everyone sees and agrees is bad. Second, you and everyone else expect the market to move hard against you. Third, and this right here is the absolute key, it doesn't. It barely budges, or maybe it even moves in your favor. That's surprise. That tells you everything you need to know. It means someone or something with a lot of power is quietly on the same side of the trade as you.
These powerful players are what traders call strong hands. We're talking about the large, informed institutional forces.
Their buying or selling is so massive that it can literally absorb all the panic from the public and keep the market from doing what everyone expects it to do. So when the market acts weird like that, it's your signal that these strong hands are on your side.
And that brings us right back to the core lesson. When you're in a position that, by all logic, should be a total disaster, and the market hands you a miraculous get-out-of-jail-free card, don't take it. That gift isn't just random luck, it's a powerful piece of information. It's the market telling you that your original idea, the one you are about to abandon, might just be right after all. The real question is, the next time you're let off the hook, will you have the guts to stay put?
Have you ever heard of the market wizards? They're this legendary, almost mythical group of traders who just achieved mind-blowing success in the financial markets. And for decades, people have been scratching their heads trying to figure out their secret. Was it some hidden strategy, some kind of superhuman discipline? Well, today, we're going to pull back the curtain on what might just be the single most important trait they all share.
And spoiler alert, the answer is probably not what you're thinking. It's not about being a math whiz or having nerves of steel, though, those things probably help. It's something much deeper, something that fuels everything else. So what is it? What's that one unifying psychological trait? Let's dive in. Okay, so here's our game plan for this explainer. First, we're going to uncover the wizard's secret, which is actually hidden right in their own words. Then, we'll explore the surprising idea of trading as a game, and we'll see what a passionate obsession looks like up close. After that, we'll tackle the myth that it's all about the money. And finally, we'll zoom out and see how this is really a universal truth for success in pretty much any field.
Right, so the secret, it's not buried in some crazy, complex algorithm. It's actually hiding in plain sight. You just have to listen really carefully to the language these top traders use when they talk about what they do every single day. So what we're going to do is look at direct quotes from these masters of the market. And when you do, this really fascinating and consistent pattern starts to emerge. It doesn't just tell us how they trade, it tells us why they trade. And that, it turns out, is the most important piece of the whole puzzle.
So what is this pattern? What's the common thread that links all these incredible performers? Well, it's that they don't see their work as, work at all. To them, it's something else entirely. For them, it's a game.
Take Bruce Kovner. He doesn't talk about his day being a stressful grind. No, he compares it to a multi-dimensional chessboard. And listen to that last part. The pleasure of it is purely intellectual. That tells you everything, right? He's driven by the strategy, the mental challenge, not just the final score. Just like a chess grandmaster.
And the pattern just keeps going with Jim Rogers. He sees the market as a big, three-dimensional puzzle. But it's a special kind of puzzle, It's one where the picture is always changing. The pieces are constantly moving. And that highlights not just the challenge, but the dynamic, ever-evolving nature of the game that keeps him absolutely hooked.
And then we get another layer with David Ryan. He calls it a giant treasure hunt. I mean, come on, that is not the language of someone who dreads going to work on Monday, is it? That's the language of adventure, of excitement, the thrill of the chase. He's not just staring at data, he's on a quest for hidden treasure.
And then you've got Monroe Trout, who just comes right out and says it. No fancy metaphors, nothing. He says, I get to play a very fun game, and I'm paid handsomely for it. He even says if he ever stops having fun, he'll just quit. I mean, that's the ultimate proof right there. The main motivation is simply the pure enjoyment of the game itself.
So, when you put it all together, you've got Kovner's chessboard, Rogers' puzzle, Ryan's treasure hunt, and Trout's very fun game. It all points to the exact same conclusion. For these market wizards, trading isn't a job they have to do. It's an endeavor they get to pursue for the sheer, unadulterated fun of the challenge.
Okay, so we've seen the pattern in their words, but what does this love of the game actually look like in real life when you take it to its logical extreme? To really get a feel for it, we need to look at a case study. So let me introduce you to Bill Lipschitz. When you look at his life, you are looking at the ultimate embodiment of this whole principle. For him, it wasn't just that he loved the game. He basically lived inside of it. His entire life was completely and utterly integrated with the market in a way that's, it's almost hard to believe.
And this just paints the picture perfectly. The guy had a quote monitor right next to his bed so he could roll over half asleep and check prices. He even had another one at standing height in his bathroom. You have to wonder, right, was that a joke about his obsession or just a practical necessity? The source suggests it was probably both. But either way, it just shows a level of dedication that goes so far beyond your typical 9 to 5.
And here's the punchline. When someone asks him if it was still fun, his answer was an emphatic, "It's tremendous fun," with 2 exclamation points. He says he would do it for free, and then, boom, he hits that core idea again. He feels like he's making all this money by playing an elaborate game. His motivation couldn't be clearer. It's just pure, unadulterated passion.
Okay, so this brings us to a really crucial point that we have to tackle head on. There's this huge stereotype out there that big-time traders are only in it for the cash. But as we're seeing the evidence from the wizards themselves, it tells a totally different story.
Trader Moshe just lays it out so perfectly. He says, flat out, no one who trades for the money is going to be any good. And his logic is so simple and so powerful. If money was the only goal, these successful traders would have made enough to just stop years ago. But they don't. Why? Because the money isn't the point.
And this right here, this really gets to the core difference between the two mindsets. Chasing money, that's a finite goal. You hit a number, and you're done. But loving the game, that's an infinite pursuit. The first path often leads straight to burnout, while the second creates this sustainable, lifelong passion. When money is the goal, work is just a means to an end. But when you love the endeavor, the work is the reward. And if you're still not convinced, this analogy from O'Shea just absolutely nails it. Jack Nicklaus had plenty of money. He did not need another prize purse. So why did he keep playing at the highest level well into his 60s? It's pretty obvious, right? It's because he just really loved playing golf. It is the exact same principle, just on a different playing field. So I know we've been talking a lot about finance and trading, but this secret, it really has nothing to do with trading at all. It's a universal truth. It applies to achieving mastery and profound success in absolutely any field you can think of. So here's the ultimate takeaway, the big lesson here. It doesn't matter if you're a trader, an athlete, an artist, an entrepreneur, the engine of greatness is always the same. It's a genuine, deep-seated love for the thing you are doing. That passion is the fuel that makes the insane amount of dedication required for mastery even possible. And the logic behind this, when you lay it out, it's just so clear. Step 1, becoming a true master of anything takes a ridiculous amount of time and effort. Step 2, it is pretty much impossible to sustain that level of intense dedication for years on end unless you are genuinely passionate about it. So the conclusion is kind of inescapable. Profound success requires loving what you do. And all of this brings us to this one core concept, what we can call love of the endeavor. It's this simple but really profound principle that says, hey, passion alone might not guarantee you'll succeed, but not having it, its absence will almost certainly guarantee that you won't. So I'll leave you with this final thought, a question to kind of turn back on yourself. The market wizards, they found the game they couldn't stop playing. They found the thing they would happily do for free. So what's yours? What is the endeavor that you love so much, the puzzle that you're so fascinated by that you would pursue it just for the pure joy of the challenge itself? The answer to that question, that might just be the most important discovery you ever make.